Let's continue marathon with the next chapter, that is FEMA 1999. The expected weightage of this chapter in your examination is 14 marks. Yes, you can see last 3 attempt question paper analysis. Jan 25 attempt, 14 marks came from this chapter. September 24 attempt, 14 marks came from this chapter. And May 24 attempt, since objective paper is not available, only in descriptive paper, 8 marks came from this chapter. By this it is very clear. You can expect 2 descriptive questions, each carries 4 marks. And 3 multiple choice questions, each carries 2 marks. So the combined weightage of descriptive portion and objective portion of this chapter in your examination is 14 marks. Simple chapter, scoring chapter. So don't take choice of this chapter. And you can also see MTPs, not less than 12 marks coming from this chapter. So minimum 12 marks. Minimum 12 marks coming from this chapter. So don't take this chapter choice. Now let's continue. This is an act to manage foreign exchange reserves of our country. First of all, why do we need foreign exchange, sir? To answer this, first you need to know about types of trade. As you all know, there are 2 types of trades. One is domestic trade and second one is international trade. What is domestic trade? In domestic trade, buyer and seller belongs to same country. That is, for example, India. So with respect to this transaction, with respect to this trade, buyer will make settlement by making payment of rupees, which is our legal tender money. Getting my point? And the usage of rupees is limited to India. And wherever I mention rupees, it indicates Indian currency, domestic currency. Clear? Next, coming to international transaction, here buyer and seller belongs to 2 countries, 2 different countries. Suppose, buyer is from India, seller is from USA. And buyer need to settle this transaction. Now, can buyer make payment of rupees to settle this transaction? No, because rupee is having a limited usage. Its usage is limited to India. So some standard unit of currency is required to settle this kind of international or cross-border transactions, and the standard unit of currency is denoted in dollars, foreign exchange. So throughout this chapter, wherever I am using the symbol dollar, it indicates a foreign exchange. Getting my point? As you all know, USA is the largest economy and strongest economy. That's why everything is measured in dollars only. Getting my point, students? Now the point is, sir, when we need dollars, of course, in case of imports, we need dollars. And in case of exports, we get dollars and we will convert the dollars into rupees. Getting my point, students? Why? Sir, first of all, why these imports, why these exports, sir? Very simple. Not every country in this world is rich with all the resources. One country may be rich at one resource. The other country may not be. For example, you take Arab countries. They are very rich at crude oil resources. And India, we are not having adequate crude oil reserves. But we need petrol, diesel for transportation. For transportation of, passengers, for transportation of food, grocery items, we need petrol and we need diesel. So where we get this petrol and diesel, we get from crude oil. Crude oil we get from Arab countries. And total defense items we get from Russia. Medical equipments, medicines we get from other countries. So for all these imports, we need to pay in dollars. Similarly, our country, if you observe TCS, Wipro, Infosys, they export services to USA. And the settlement will be done in foreign currency. That means we get dollars. So in one case, we are making payment of dollars. In another case, we are getting the dollars. Making payment of dollars means nothing but purchase of dollar, which is denoted with demand. Getting my point? Next one, in case of exports, we get dollars, we convert dollars into rupees. That means it indicates supply. It indicates supply, sale of dollars. First of all, sale of dollars, sale indicates supply. So when there is an equality between demand and supply, there is no issue at all. Sir, what is this sale, sir? Seema, I'm exporting services. I'm exporting some services to US citizen. I'm getting dollars. I can't use dollars in India. I need to convert them into rupees. Now I sell dollars to the banker. Banker will pay me rupees. Sale indicates supply. So if demand is equal to supply, there is no problem. If demand is less than supply, then price of an article will fall down. Suppose if demand rises, if demand is more than supply, then price of an article increases. Here, article is nothing but dollars. Getting my point? More exports, no problem. But more imports, what happens? We pay more dollars, but we receive less dollars in case of more imports and less exports. So demand for dollar is increasing, whereas supply of dollar is getting reducing. As a result, what happens? Price of an article, that is dollar, gets increased. For example, today dollar price, for example, $1 is equal to 85 rupees. Imagine. When demand exceeds supply, what happens? Dollar value will go up to 90 rupees. So that means dollar is getting appreciated, rupee is getting depreciated. Problem. Suppose demand is less than supply. In that case, what happens? Dollar value may fall. For example, dollar value is coming to 70 rupees. Now here rupee value is getting appreciated, dollar value is getting depreciated. This is actually good for Indian economy. Getting my point? Now we need to manage our foreign exchange reserves in such a way that we need to finance all our basic imports, basic necessaries. In the absence of this chapter, what happens? Suppose imports are going up, and exports remain constant, imports greater than exports, definitely foreign payments get increased, whereas receipts are constant. One point of time our foreign exchange reserves become zero. In that case, we can't even finance crude oil purchases, we can't even finance defense item purchases, we can't even finance medicines, basic medical equipment also we can't finance. So we must maintain adequate foreign exchange reserves, so that in emergency situations we can easily come up, we can easily overcome in emergency situations. Getting my point, students? Now this is just a basic introduction about FEMA 1999. So next important point is objective, preamble, objective of the FEMA 1999. Very very important, ma. You have to remember 2 points. So the two important or two key objectives of FEMA is facilitating external trade and payments. Of course, here trade refers to domestic or international, but coming to this chapter, trade means international trade, external trade. When we are having adequate foreign exchange resources or reserves, definitely we can go with imports, definitely we can go with external payments. So facilitating external trade and payments, this is one key objective of FEMA. Second key objective of FEMA is development and maintenance. What kind of development? Orderly development and maintenance of foreign exchange market in India. Getting my point? If you ask SEBI, what is the main objective of SEBI? SEBI main objective is maintenance of stock exchange market in India. But coming to FEMA, maintenance of foreign exchange market in India. Dollar value 85 rupees, dollar value 90 rupees, or dollar value 80 rupees. So this kind of market, demand for dollar, supply of dollar, for that, FEMA's secondary main objective. Getting my point? What are the two key objectives of FEMA? One is facilitating external trade and payments. Second one is promoting an orderly development and maintenance of foreign exchange markets in India. Foreign exchange markets in India. Next one, FEMA is applicable to whole of India. And it is also applicable to branches, offices, agencies. Shortcut I denote it as BOA. Branches, offices, agencies located outside India. Sir, what about in India? If branch or office or agency located in India, obviously FEMA is applicable, because FEMA extends to whole of India, correct? FEMA extends to whole of India means FEMA is applicable to all the branches, offices, agencies that are located in India. Now here I am talking about branches, offices, agencies which are located outside India. Of course, if they are owned or controlled by person resident in India. So our Indian resident, if he is controlling any branch or office or agency which is located outside India, then to those branches, offices, agencies also FEMA 1999 is applicable. Getting my point, students? Everyone. First of all, FEMA is applicable to whole of India. All foreign exchange transactions in India are subject to FEMA 1999. Next one, if a transaction is done by a branch or office or agency located outside India, but if that branch or office or agency is controlled by or owned by person resident in India, then also to those branches, offices, agencies, FEMA is applicable. And FEMA also covers contraventions, defaults which are committed outside India by anyone to whom Act applies. So FEMA is applicable to transactions. FEMA is applicable to foreign exchange transactions, and also FEMA is applicable to defaults committed outside India by anyone to whom this act applies. To whom this act applies means to the residents only. So residents carrying foreign exchange transactions outside India, if they commit any default, for them also FEMA will apply. That means punishments under FEMA will apply. Everyone. Suppose Russian citizen, USA citizen, both entered into a transaction, foreign exchange transaction only. to this FEMA applicable or sir? Not applicable. Why not applicable? Because Indian resident is not there. Indian resident is not involved. Transaction is happening outside India, and the transaction is between two persons who are not residents of India. They are not residents of India. So simply, a foreign exchange transaction between resident to non-resident, or between non-resident to resident, or between two residents, for example, only with respect to these transactions only, yes, FEMA is applicable. Suppose foreign exchange transaction between two parties who are non-residents, buyer is from Russia, okay, seller is from USA. Now FEMA applicable or not applicable? FEMA is not applicable. When I'm telling the two residents, that means, these two parties belongs to India, but transaction happening in, for example, dollars, then also FEMA is applicable. So simply remember, FEMA is applicable to all foreign exchange transactions that are carried out in the India. Next one, FEMA is applicable to all the transactions entered by a resident outside India. Entered by who? Indian resident outside India. But FEMA is not applicable to the transactions which happened outside India between two non-residents. Next one, FEMA came into force with effect from 1st June 2000. So effective commencement date. What is the commencement date? What is the commencement date of FEMA 1999? Commencement date is 1st June 2000. Can I proceed? Definitions. In this, main important definitions I'll discuss with you. Capital account transaction, very important. Current account transaction, important. Foreign exchange, important. Foreign security, also important. And very important, person resident in India. So I'll cover all these definitions. First one, I'll start with a foreign exchange. So what is a foreign exchange? You can see here, foreign exchange means foreign currency. Foreign exchange means foreign currency, also includes deposits, credits, balances payable in dollars. Denominated in dollars, it becomes foreign exchange. Next one, instruments, namely bill of exchange, letter of credit, LCs, traveler's check, drafts. If they are drawn in rupees but payable in foreign currency, or if they are drawn outside India but payable in rupees, then also those instruments become foreign exchange. Very simple definition. Foreign exchange means what? Foreign exchange means foreign currency. And also foreign exchange includes deposits, credits, balances payable. In which currency? Foreign currency. Suppose if it is payable in rupees, then it is not foreign exchange. It's an Indian transaction only. It's not foreign exchange transaction. Getting my point? So deposits, credits, balance payable in foreign currency. Next one, instruments. Talking about negotiable instruments like, bills of exchange, ELCs, traveler's checks, draft. They should be drawn in rupees and payable in foreign currency, or drawn outside India but payable in rupees. Any combination, I'm writing here, or any combination satisfied, then it becomes foreign exchange. Come on, tell me. Drawn in rupees, payable in foreign currency, or drawn outside India but payable in Indian currency, then it becomes foreign exchange transaction. Next important definition, foreign security. It means security denominated in rupees. Rupees or dollars? Dollars. If security is denominated in rupees, it becomes Indian security. Reliance shares, TCS shares, Tata company shares, Adani company shares, Birla Group of Industries, Birla company shares, all these are Indian securities, domestic securities. But here the definition is all about foreign security. So foreign security means security which is denominated in dollars. Simply, if face value is, for example, $10, then that security is called obviously foreign security. For example, Microsoft, Apple, company, Visa, all these, all these securities are denominated in dollars. That's it, they become foreign security. Next one, foreign security includes securities that are denominated in foreign currency, whereas redemption or returns are in domestic currency. Getting my point? That means what? If you observe carefully, this part is common here also. Extra part is, even though the redemption or returns is in rupees, but still it is a foreign security only. So that means it is very clear, foreign security, it should be denominated in foreign currency. Whether redemption or returns by the way of, dividends or interest, they may be paid in rupees, But if security is denominated in foreign currency, then it becomes foreign security. Everyone getting my point? So foreign security, what is the important condition to be satisfied? That security should be expressed or should be denominated in foreign currency. Getting my point? Whereas redemption or returns may be in foreign currency or maybe in domestic currency, that is Indian currency, but still that security becomes foreign security. Suppose if security is denominated in rupees, it is not foreign security, it is Indian security, domestic security. Clear? Next one, very important definition. Students usually get doubts with respect to this definition. Sima, observe carefully. Person resident in India. Here I am categorizing persons into two categories. Individual, other than individual. One category is individual, other category is other than individual. In case of others, very simple. If place of incorporation in India, they become Indian resident. If the branch or office or agency located in India, then also they become resident. Next, branch, office, agency located outside India, but they are owned or controlled by Indian residents, then also they become residents. See, under FEMA, citizenship is not a criteria. To apply FEMA, we are not, to apply FEMA, we are not focusing on citizenship. We are focusing on residential status. Are you all getting my point, students? Everyone. So residential status, how residential status of a person is determined? In case of other than individual, place of incorporation, place of location, and who are controlling it, who are managing it, who are owing it. For example, listen carefully. For example, Microsoft Incorporation, a company is there. It is having one branch office located in India. Any branch located in India by default becomes resident. Everyone. Suppose Microsoft India is having another branch which is located in Australia. Now branches located outside India, they are not Indian residents, they are not person resident in India. But in case if this branch is owned by Indian branch or controlled by, either owned, that means 100%, or funding is done by Indian branch, or key decisions are taken by Indian branch. Now even though this branch is located outside India, since it is either owned or controlled by Indian resident, automatically Australian branch becomes resident. Australian branch of Microsoft Incorporation becomes resident to India. Why? What is the logic? Because the branch located in Australia is controlled by or owned by branch office located in India. Branch office located in India is already resident. You apply this point. Branch located in India is Indian resident. If this branch located in India is controlling another branch which is located outside India, that outside India branch also becomes Indian resident. So with respect to other than individual, very simple. Place of incorporation, place of location, and who are controlling the branches, who are regulating those branches, offices, agencies is important. Now coming to individual, period of stay determines residential status. Sir, in which year we need to check, sir? Preceding financial year. Right now we are in the financial year 2025-26, correct? Yes, sir. So with respect to this financial year, we need to check preceding financial year, which is 2024-25. With respect to 24-25, if his period of stay is greater than, more than 182 days, then he becomes Indian resident, person resident in India under FEMA 1999. But of course, even though this general rule is satisfied, sometimes he may become non-resident, or even though the general rule is not satisfied, but still he may be called a resident in the exceptional cases. So what are those exceptional cases? First of all, tell me, what is the general rule for individual, ma? What is the general rule for individual? For individual, general rule is period of stay in the preceding financial year is greater than 182 days, then current financial year he becomes resident. But exceptions, suppose any person is leaving from India for the purpose of employment outside India or business outside India, or intention to stay outside India for uncertain period, then these people, even though they satisfy general rule in the preceding financial year, from the date they leave India or the date they left India onwards, they are not residents, they are treated as non-residents. For example, For example, Mr. Ramu is there. Preceding financial year 2024-25, his period of stay is 360 days. How many days he stayed in India? 360. But in the current financial year, on 1st September 2025, he went to USA. The purpose of visiting USA is to take up a job or to start a business, or his intention to stay outside India is for uncertain period. There is no certainty with respect to period of stay. Now what happens, 1st September 2025, he left India. From that date onwards, he will be treated as non-resident, even though his period of stay in the preceding financial year is 360 days. That means greater than 182 days. Getting my point? So once he left India for the purpose of job outside India, business outside India, uncertain period, intention to stay abroad for uncertain period, no need to apply this act to that person. So that person is treated as non-resident. Getting my point? Logic is very simple, ma. Suppose if you call that person as a resident, listen to the logic. If you understand the logic, you can easily remember this definition. So the logic is, if you treat him as a resident, okay, so he joined employment. In this employment, he is getting every month $10,000. As per FEMA 1999, he should not possess dollars. He should not own dollars. Immediately, he should convert it into rupees. For example, in rupees, some 8.4 lakh rupees. Okay, now he need to make payment of rent, sir, or he need to purchase grocery items, sir, or he need to incur some expenditure for his livelihood. Again, going to RBI or going to central government, converting rupees into dollars whenever required. Tell me, is he carrying transactions in India or outside India? Outside India. Why? He got a job outside India. But still, if you ask him to apply FEMA rules, if you ask him to comply with FEMA, again, he need to come back to India. He need to communicate with RBI. He need to convert the dollars into rupees, and again, rupees to dollars, dollars to rupees in case of income, rupees to dollars for making expenditures. Tell me, definitely it's a harassment. Definitely it's an harassment. So that's why from the date he leave India up to the date he is a resident. But once he left India, he will be considered as non-resident. From that point onwards, FEMA is not applicable to that person. Getting my point, students? Similarly, suppose, Mr. Maxwell, in the preceding financial year, his period of stay is 0. Current financial year, exactly on 1st September 2025, he visited India. What is the reason? To start business in India. Now, the moment he enters into India with an intention to start business in India, he will be called resident, even though his period of stay in the preceding financial year is less than 182 days or not more than 182 days. Getting my point? Logic is very simple. If you call such fellow as non-resident, now every person dealing with this fellow, communication with RBI, getting approvals from RBI is harassment only. So that's why the purpose of visit, if it is falling under job category or business category or uncertain period category, if he is coming to India, then he will be treated as resident, even though his period of stay in the preceding financial year is less than 182 days. Suppose if he is going outside India, no, that means simply abroad. He is going to abroad. Now, even though his period of stay in the preceding financial year is greater than 182 days, from the date he left the country, he will be treated as non-resident. So very simple, tourist, if you observe tourists coming to India for tourism purpose, they are non-residents. Again, our Indian citizens or Indian residents going abroad just to visit places, to visit Dubai, to visit Australia, just visiting purpose, not job, not business, not uncertain period intention, then also they will be treated as residents only. Not they won't become non-resident, they become residents. And residential status under FEMA is somewhat different compared with income tax. Why? Because in income tax act, residential status we check for year basis, but here residential status we check on each and every day basis, day-to-day basis. Yes, day-to-day basis. Suddenly he left India for the purpose of taking up employment, business, vocation, or intention to stay in India, intention to stay abroad for uncertain period. From the date he is leaving India up to that date he is a resident, after that date he is a non-resident. That means in 1 year he can have a residential status, that means resident, again he can become non-resident. or up to one point he may be a non-resident. After that point he becomes a resident. That means he can maintain two residential status under FEMA. One is resident up to one date, and from next date onwards non-resident. Or someone, foreigner coming to India to take up employment in India, or to take up to start a business, or intention to stay in India for uncertain period. Foreigners coming to India with these purposes, up to the visit date they are non-residents. Once they step into India, they become residents. Getting my point? That means in a year a person may be a resident up to one point of time and non-resident for remaining point of time, a remaining time period. Similarly, a foreigner may be non-resident up to one point of time, and for remaining period he may become a resident. Getting it? Everyone? So person or body corporate registered incorporated in India becomes person resident in India. Throughout this chapter, PRII means resident only. PROI means non-resident only. Getting it? Next one, branch office agency in India owned or controlled by a non-resident. Branch office agency outside India owned or controlled by a person resident in India. Here control is not a matter. With respect to third point, control is not a matter because they are located, these branches are located in India. They become residents. D point, located outside India, who is owning that branch, who is controlling that branch is a matter. That means if resident is controlling a branch outside India, if a resident is having ownership on one branch located outside India, then the foreign branch is also treated as resident. Clear? So important key definitions, three definitions I completed. Foreign exchange over, foreign security over, person resident in India is over. Now two more definitions, capital account transaction, current account transaction. Listen carefully. Capital account transaction, it's a transaction that alters assets, liabilities, contingent liability outside India of resident, or assets, liabilities in India of non-resident. Very simple definition, CAT, it means capital account transaction. It's a transaction which affects residents' net worth outside India. Residents' net worth outside India. Here net worth refers to assets minus liabilities. Here liability also includes contingent liability. Our country follows prudence concept. Prudence concept means anticipate all future losses but don't anticipate future incomes. Correct? So that's why here liability also includes contingent liability. And next one, capital account transaction. It's a transaction which alters non-residents net worth. Non-residents net worth located in India, situated in India. Here net worth means assets, liability only, but not contingent liability. Why? Non-residents contingent liability is nothing but India's contingent asset. See, first of all, contingent liability, for example, Mr. Ramu, Indian resident, giving a guarantee to World Bank on behalf of Mr. Maxwell, Australian citizen, Australian resident. If Maxwell fails to pay this amount, then who is liable to pay this amount? Ramu is liable to pay this amount. So first of all, this is liability, but this is not certain liability. This is contingent liability. Why? Maxwell's non-payment determines Ramu's liability. So Maxwell's performance determines Ramu's liability. That's why if Maxwell is not making payment, then Ramu is liable. This is contingent liability. So from Indian point of view, Indian perspective, it is a contingent liability. Getting it? Exactly reverse. For example, State Bank of India is there. Maxwell is taking a loan. Or for example, not Maxwell, Ramu is taking loan from SBI. If Ramu, SBI took guarantee from Maxwell. So guarantee contract, you all know, if Ramu fails to pay amount, then Maxwell is liable to pay this amount. Correct? So SBI point of view, this is a asset. Maxwell is an asset. What kind of asset? Certain asset? Contingent asset. Why? If Ramu fails to pay, then Maxwell is liable. So Ramu's performance determines Maxwell's liability. So this is contingent liability from Maxwell point of view. But from other party point of view, that is SBI point of view, this is an asset. Getting my point, students? Seema, I borrowed 10,000 from you. For me, you are my liability. I need to pay this amount. And for you, I am your asset. You are having a right to recover amount from me. Similarly, in trade transaction, for me, if you are liability, for you, I'm asset, correct? If you are, if I am contingent liability to you, that means you are having contingent asset on me. As per our country's prudence concept, anticipate all future losses but don't anticipate future profits, correct? That's why we recognize contingent liabilities of residents and we don't determine contingent liabilities of non-residents. Why? From non-resident point of view, liability means from our country point of view, it is an asset. Contingent liability means contingent asset here. So we don't consider contingent assets. That's why non-resident point of view, contingent liability point is not there. Okay na? Okay na? Now listen carefully. Any transaction that alters net worth of which fellow? A resident fellow. Where that net worth is there? Outside India. So residents net worth outside India is getting affected. That is a capital account transaction. Or non-residents net worth is getting affected in India. Non-residents net worth is getting affected in India. Then also the transaction becomes capital account transaction. See, generally students get confused between capital expenditure and capital account transaction. Capital expenditure, capital account transaction, both are not same. For example, I'm importing plant and machinery. I'm importing plant and machinery from UK. Getting my point? So I'm getting one asset from UK. This asset, I'm purchasing from UK and installation is happening at factory located in India. Now tell me, for me, any foreign asset created or any foreign liability created, so no foreign asset, no foreign liability, sir. In that case, how it becomes capital account transaction? It is not capital account transaction. It may be a current account transaction. Getting my point? Suppose, I purchased plant and machinery and I equip it, I installed that plant and machinery in UK only. In UK, I'm having a factory. In UK factory, I installed this plant and machinery. Now, a foreign asset has been created. Residents foreign asset created or residents foreign liability created. Then it becomes capital account transaction. So very simple. Just look at the point one more time. Capital account transaction means a transaction that alters residents assets, residents liabilities including contingent liability where outside India. Similarly, non-resident assets, non-resident liabilities located in India. That's it. Current account transaction, any transaction other than capital account transaction including payment for foreign trades, services, banking and short-term credit facilities. So specifically these 4 transactions are mentioned as current account transactions, CUT, current account transactions. What are those 4 transactions? All trade related transactions, foreign trade, buying and selling, raw materials, service, import of services, export of services, short-term credit facilities. It's not long-term credit facilities, short-term credit facilities deemed to be current account transactions. Next one, interest on loans, investments income are also treated as current account transaction. But here you have to pay attention. This loan is nothing but, foreign loan, for example, foreign loan, or this investment is foreign investment outside India or loan outside India. These two are capital account transactions only. But with respect to these loans, we are paying interest. With respect to these investments, we are receiving incomes. Those incomes, those interest expenditures are treated as current account transactions. For example, Mr. Ramu acquired 100 Microsoft shares, 100 Microsoft shares. Each share, for example, $200. Now, how much total investment he made? $20,000 investment he made. This investment of $20,000 is capital account transaction. Every year Microsoft is paying dividend of 10%. So that means, for example, $2,000 he is getting dividends. Now this dividend, which is a recurring income, which is a regular income, dividends, these dividends becomes a current account transaction. Getting my point, students? Everyone. Similarly, I took a loan of $10,000 from HSBC bank located in USA, for example. Now the $10,000, it's not a short-term credit facility. So that loan is capital account transaction, whereas payment of interest on that loan is current account transaction. So every month I am paying EMI, for example, $1,000. Out of this $1,000, $200 is interest, $800 is principal. Now payment of $1,000 where $800 principal amount is getting reduced, this becomes capital account transaction. And $200 which I'm making payment as interest, that interest payment comes under current account transaction. Clear everyone? So in installment, interest expenditure is current account transaction, whereas principal settlement is capital account transaction. That's it. Next one, remittances for living expenses of family abroad. Next one, expenses for foreign travel, foreign education, medical care. So these 4 transactions are deemed to be current account transactions. Remember these points, very important. So they may ask you a list of transactions. They will ask you what is the nature of transaction, capital or current. Getting my point? And similarly, they will also test these points, whether it is foreign exchange transaction or not foreign exchange transaction. They may also ask you whether it is a foreign security or not a foreign security. And they may also ask you whether the person is a resident or not resident. 5 definitions, very important. Can I proceed? Okay, next one. So residential status already discussed with you. Just to give one time reading, basic, all the examples that are covered in study material, I already summarized those examples in my material also. Just give one time reading, you'll get clarity. Next, section 3, section 4. These are also important concepts. So far question not came, but chance is there. Question may come from this section 3 and section 4. See, according to section 3, no person is allowed to deal in foreign exchange. No person is allowed to deal in foreign exchange. According to section 4, person resident in India cannot hold foreign exchange. So section 3 is talking about dealing of foreign exchange. Section 4 is talking about holding of foreign exchange. Section 3 is applicable to all persons. All persons means resident as well as non-resident, whereas section 4 is applicable only to resident. Here you can see a person resident in India. See, these are the key differences between section 3 and section 4. Section 3 applies to all persons. Resident or non-resident are not a criteria, whereas section 4 applicable to resident. Section 3 talks about dealing of foreign exchange. Section 4 talks about holding of foreign exchange. Let's see the point. No person shall deal in transfer foreign exchange, foreign security unless they are an authorized person. No person shall make payments to a person resident outside India without RBI permission. No person shall receive payments from non-resident other than through authorized person. No person shall enter into financial transactions in India to acquire, create, transfer of assets outside India. If you remember key objectives of FEMA, what is the second key objective of FEMA? Orderly development and maintenance of foreign exchange markets in India. See, maintenance of markets in India means everything should be recorded. Transparency should be there. So that means all foreign exchange transactions should be accounted, recorded. It will happen only if the transactions happen through one recognized medium. Here, recognized medium is none other than authorized person. Authorized person includes authorized dealer, offshore banking unit, money exchangers. Getting my point? Simply, RBI permitted agencies where you can get, foreign currency by exchange of Indian currency, or where you get Indian currency by exchanging foreign currency. So now the point is, if you want to deal with foreign exchange, you can't deal it directly, but through authorized person you can deal it. If you want to make payments outside India, through authorized dealer you can make payment. If you want to receive amounts from outside India, I provided service to a non-resident with respect to filing of income tax returns. He paid me $100. Now I cannot receive $100 directly. First, I should receive it through authorized person. That authorized person will convert $100 into rupees. That rupees I can take, I can possess. The dollars I cannot take, I cannot possess. Getting my point? Next one, no person enter into financial transactions. No person shall enter into financial transactions. Of course, to these 4 points we had exceptions. The exceptions is these transactions can be carried out if they are specifically permitted under FEMA, or even with general or special permissions from RBI also you can carry these transactions. So without FEMA permissions or without RBI special or general permissions, you cannot carry these transactions. Getting my point, students? So transactions, classified into 3 parts: permitted, freely permitted, prohibited. Prohibited transactions you cannot carry. For carrying prohibited transactions, you cannot use foreign exchange. For permitted, you can use it. See, financial transaction means, making, receiving payments to or for another person, issuing, drawing, negotiating bills of exchange or promissory notes, foreign exchange only, transferring securities or acknowledging the debts. So if you want to buy, for example, if you want to buy Reliance Industry Limited share, for this, you need to have a demat account. If you have demat account, you can purchase the Reliance shares, you can purchase Tata shares, you can purchase Airtel shares, like that, Adani shares, you can purchase it. So similarly, if you want to purchase foreign securities, you must maintain a demat account authorized by RBI, authorized by central government, or through authorized person. You can open that account, you can trade foreign securities. So what is the main objective of section 3? Regulates inflow and outflow of foreign exchange, ensures transactions are conducted through authorized dealers, applies to both residents and non-residents. So through this, it is possible. What is possible? Orderly maintenance and development and maintenance of foreign exchange markets in India. Clear, everyone? Next one, section 4, holding of foreign exchange. Here I am talking about only resident. A resident cannot acquire, hold, own, possess, transfer foreign exchange, foreign security, immovable property abroad unless permitted under FEMA notifications. So unless permitted under FEMA, no resident can receive foreign currency, can hold foreign currency, own foreign currency, possess foreign currency, or transfer foreign foreign exchange proceeds. So everything should happen only when there is a permission under FEMA, or only when there is a through authorized dealer. The main objective, once again I am telling you, section 3, section 4 main objective is development and maintenance of foreign exchange markets in India. For that, accountability, transferability, transparency are required. Ensuring these two things, FEMA is there. That's it. Next one, current account transactions. Any person can sell, draw foreign exchange from an authorized dealer, or he can sell foreign exchange to authorized dealer. See, can sell foreign exchange to authorized dealer, can draw foreign exchange from authorized dealer, if it is a current account transaction. That means current account transactions are freely permissible. Current account transactions are freely permitted, unless specifically prohibited. Exactly reverse to the capital account transactions. Capital account transactions are prohibited unless permitted. So tell me, what is the general rule? Current account transactions are freely permitted unless prohibited, whereas capital account transactions are prohibited unless permitted. Very simple, What is the first key objective of FEMA? To facilitate external trade. Trade transaction means capital account transaction, current account transaction. I told you, by default, trade transactions, short-term banking facilities, credit facilities, all this comes under current account transactions. So when your objective is to facilitate external trade, that means all current account transactions are freely permitted, whereas capital account transactions are prohibited. Of course, current account transactions may be prohibited, capital account transactions may be permitted, specifically or generally. Can I proceed, everyone? Import of machinery is a current account transaction. Why? No creation of foreign asset outside India. So it becomes current account transaction. Import on credit, if this credit, you need to observe whether it is for short term or long term credit or short term credit. Short term credit, by default, it is current account transaction. Long term credits are, then it becomes capital account transaction. Next one, gift. Gift is both capital account transaction as well as current account transaction. How? Suppose I'm giving a 10,000 rupees gift to my brother, resident of USA. So when I'm giving gift to my brother, so he's holding 10,000 rupees in India. I'm having 10,000 rupees, that money I transfer to his account, which is located in India, but he's a non-resident. Now for non-resident, one asset is created in India. Creation of asset in India by non-resident becomes capital account transaction. Suppose my brother gifted me $1,000. As per section 4, I cannot possess these dollars. I need to get them. I need to convert them into rupees. Getting my point? Upon conversion, Upon conversion into rupees, observe carefully, for me, no creation of foreign asset, no creation of foreign liability. No creation of foreign asset to no creation of foreign liability. Then automatically it becomes which transaction? Current account transaction. Very simple point I'm telling you. Resident point of view, asset created outside India, liability created outside India, contingent liability created outside India, it becomes capital account transaction. Non-resident point of view, asset created in India, liability created in India becomes capital account transaction. Any transaction other than capital account transaction, we call it as current account transaction. Getting my point, students? Everyone. So Indian resident gives $1,000 to his NRI brother in New York. Once gift is transferred, no asset or liability is created in India or USA. Hence, it becomes current account transaction. So creation of asset in India or outside India is important. So same logic, section 4 you can follow in 5th point. You can see here, gift in rupees from resident to non-resident. This creates Indian asset for non-resident, making it capital account transaction. That's what I told here. Next one, gift from non-resident to resident allowed. However, if the funds are given abroad, resident must repatriate them. That means he need to get back them. He need to get back them to India, and dollar will be converted into rupees. As the result, what happens? No foreign asset, no foreign liability for resident. It becomes current account transaction. Explain the logic here itself. Next one, restrictions imposed by CG in current account transactions. These current account transactions are classified into 3 schedules. 3 schedules. First one is prohibited current account transaction. Next one is CG permitted current account transactions. Last one is RBI permitted current account transactions. How many categories? 3 categories. Prohibited current account transactions, CG permitted current account transactions, RBI permitted current account transactions. So schedule 1 talking about prohibited transactions. Let me tell you one point very clear. These transactions are not illegal transactions. These are not illegal transactions. But for carrying these transactions, withdrawal of foreign exchange is prohibited. Withdrawal of foreign exchange is prohibited for carrying the following transactions. Getting my point? So what are those transactions? Remittances out of lottery winnings, remittances of income from racing, riding, etc. So in these 2 cases, what happens? In these 2 cases, dollar is going outside India. Our foreign exchange reserves will fall. And lotteries, racing, riding or something, they can be manipulated. They can be manipulated. So your intention is to send dollars outside India illegally. So that's why prohibited. Withdrawal of foreign currency for carrying these transactions is not allowed. And C point, remittances for purchase. 1, 2, they are winnings. C is about tickets, lottery tickets, subscription of the, this racing, riding or prescribed magazines, football pool, sweepstakes, for purchase of these tickets, where these tickets are available outside India. For purchase of these lottery tickets, can I withdraw dollars, sir? No, not allowed, not allowed. So that means first 2, non-resident winning in India. Last, third point is resident purchasing tickets outside India. Both are prohibited. Getting my point, students? Next one. D and F. D and F. Commission on exports. Commission on exports. Generally, commission on exports. For payment of commission on exports, withdrawal of foreign exchange is allowed. But what is the main objective of exports is important. Here you are making exports so that you get money, and that money you are not bringing to India. You are not bringing back that money to India. You are utilizing that money as an equity investment in joint ventures, wholly owned subsidiaries in India or outside India? Outside India. So in this case, our Indian economy is not receiving dollars. Then how our Indian government or our Indian RBI permits you to withdraw dollars for payment of commission on such exports? If I get $10,000, I'll give you some $500 for making payment of commission on exports. But here, in D point, in F point, I'm not getting foreign money. Why? In D point, you are using that foreign currency for equity investment outside India. So with respect to those exports where the funds you are utilizing for investments outside India, on those exports, commissions if you want, you can pay. But for that, Withdrawal of foreign currency is prohibited. And F point, here exports is under rupee state credit route. That means here Indian government will receive rupees only. When Indian government is getting rupees, how it will give you dollars for making payment of commission on exports? Indian government is receiving rupees. If Indian government allows you to withdraw dollars, what happens? Our foreign reserves will fall. It may become zero. So that's why under rupee state credit route, whatever exports you are doing, so there you get rupees only, not dollars. So against that exports, commission on exports, withdrawal of foreign exchange is prohibited, but there is one exception. Exception under prohibited current account transaction means allowed. Generally, prohibited current account transactions are not allowed. But in that one exception means what? That prohibition will not apply. You can withdraw foreign exchange for carrying the transaction. Sir, what is that exception, sir? With respect to exports of tea and tobacco, what? Exports of tea and tobacco, up to 10% of invoice value, you can pay commission in foreign currency. You are allowed to withdraw foreign exchange, foreign currency, up to how much? 10% of invoice value. Not all products, only tea and tobacco. Okay, now next one, remittances of dividends by any company to which dividend balancing is applicable. Understand this point, small example I will tell you. For example, Kia company is there. Kia Motors company is there. Kia company produced some 10 lakh cars, manufactured some 10 lakh cars. Out of 10 lakh cars, 4 lakh cars were sold in India. And the remaining 6 lakh cars were sold outside India. From the 6 lakh cars, company Kia received profits in dollars. And from these 4 lakh cars which were sold in India, company received profits in rupees. Now, our Indian company Kia is having a parent company which is a South Korean Kia company. South Korean company. Now, our Indian company wants to pay dividends. Getting my point? Now, payment of dividends with respect to profits of 6 lakh cars which were sold outside India, withdrawal of foreign exchange is allowed. But with respect to profits that were generated in India, with respect to these payments, with respect to payment of dividend from these profits, withdrawal of foreign exchange is not allowed. Logic is very simple. With respect to 6 lakh cars, Indian economy received dollars. So out of that, if you want to make payment of dividends, you can do it. But whereas 4 lakh cars which were sold in India, there, Indian economy didn't receive any foreign exchange. Indian economy received only rupees. Now, if you convert that rupees into dollars, if you are making payment of the dollars, what happens? Our foreign exchange reserves will fall. So dividend balancing concept means this only. Okay, na? Everyone. So the profits generated in India. From that profits, if you want to pay dividends in rupees only. Now the profits generated out of sales which happened outside India, where Indian economy is receiving dollars. From that amount, if you want to pay dividends in dollars, yes, allowed. Next one, callback services. Right now, this is outdated topic. Payments with respect to callback services is also prohibited. Foreign exchange withdrawal is prohibited. Remittances of interest income on funds held in non-resident special rupee scheme account. Non-resident special rupee scheme account. So what is this concept? See, for example, Mr. Donald Trump decided to stay in India for the next 6 months. He cannot pay dollars. Correct? Whatever, stay for 6 months, food expenses, traveling expenses, he can't pay dollars. He need to pay in rupees only. So the moment he comes to India, whatever money he is having, that amount will be deposited in non-resident special rupee scheme account. Non-resident special rupee scheme account. So on that balance amount, if any bank is paying interest, he opened account with SBI. He deposited some 8 crores rupees. He deposited actually $1 million. Upon conversion, it became 8 crore rupees. Now, the time he is leaving country, that 8 crores became 9 crores. Why? That 1 crore, interest got accumulated, for example. Now, that interest income, remittances will be done only in rupees, but not in dollars. That interest income, getting my point, interest income on the funds held in special rupee, non-resident special rupee scheme account, that remittance of interest, withdrawal of foreign exchange is prohibited. If you want, these 8 crores, you can convert into dollars, you can withdraw this money. But on these 8 crores, for example, 1 crore interest got accumulated. This accumulated interest can be used, this accumulated interest, for remittance of this accumulated interest can be Withdraw foreign exchange? No. Withdrawal of foreign exchange with respect to remittance of interest income on these accounts is prohibited. Can I proceed, everyone? Everyone. Next, schedule 2 transactions, as I told you, prohibited over. Next one, CG permitted. Schedule 2 is all about transactions which require prior approval of CG. Prior approval of CG. Let's see. Cultural tours. Lot of, in MTPs, if you observe, previous examination questions you observe, lot of questions came on cultural tours. In case of cultural tours, permission from CG is required. Which department? Department of Education and Culture required. So Ministry of Human Resources Development, department name is Education and Culture. Department of Education and Culture permission is required for withdrawal of foreign exchange against cultural tours. Here there is no limit on dollars, even $1 also, even one unit of foreign exchange also permission is required. And payer can be any person. Payer can be any person. Next, advertisement. Another tricky point, if my guess is correct, this point can be tested in the upcoming examination. Advertisement in print media for the purpose other than promotion of tourism, foreign investments, international bidding, exceeding $10,000 by a state government and its public sector undertakings. So here, who the payer is? Payer is state government, public sector undertakings. Purpose is advertisement. In which media? Print media. What is the main reason of advertisement? What is the main purpose of advertisement? For carrying activities other than promotion of tourism, foreign investments, and international bidding. And how much amount is involved? Exceeding $10,000. Then Ministry of Finance permission is required. To understand this better, let me write here. Advertisement. Advertisement. So advertisement in which media is important? Suppose it is print media or other media. In case of other media, that means YouTube, television, permissions not at all required. Print media, you have to check the purpose. Sir, purpose is promotion of tourism, promotion of international bidding, promotion of investments. Okay, then no problem. Sir, other purposes, sir. Oh, others, okay. Who is making payment? Sir, payment is done by state government, public sector undertakings, others, sir. Oh, others, no problem. If it is SG, PSU, then you have to check the amount. Sir, amount is less than or equal to $10,000, sir. Permission not required. Sir, amount exceeding $10,000, sir. Now permission required. Observe carefully, Advertisement in print media by state government PSU for a purpose other than tourism, international bidding, investments exceeding $10,000. Then permission is required. So who the payer? State government, public sector undertaking. How much amount? Exceeding $10,000. And where advertisement is appearing? In print media, not other media, not YouTube, not television, broadcast messages. Getting it? Print media. What is the purpose? Purpose other than promotion of tourism, other than investments, other than international bidding. Everyone. Next one, remittance of freight of vessel chartered by a PSU. To encourage domestic ship vendors, this point is there. Remittance of freight in foreign currency. Freight, when you are paying a foreign currency, when you are paying money for freight outside India, that means you are getting services from ships outside India, shipping companies outside India. If any PSU wants to make payment to a shipping company outside India with respect to freight expenses, Ministry of Surface Transport permission is required. Next one, payment of import through ocean transport. Transportation is through ocean transport. And who the payer is? Payer is government department or a PSU. If it is on cost insurance freight basis, if it is on SIF basis, then Ministry of Surface Transport permission is required. Suppose if it is FOB, free on board, FAS basis, then permissions not required. SIF basis, and who is making payment? Government departments, PSUs. If that import is through ocean transport, then also permission is required. One is freight charges with respect to shipping companies located outside India. Other one is imports through ocean transport. If it is on cost plus insurance plus freight basis, where all these amounts are paid to seller itself. Here also, if PSU or SG, government departments are making payments, for these payments, withdrawal of foreign exchange requires Ministry of Surface Transport permission. Next one, multimodal transport operators, national geography channels or sports channels, where they provide telecast, live telecast services. With respect to, I'm sorry, that is second point. No, multimodal transport operators, that means, you are sending goods. Initially road transport is involved, next ocean transport, next one, railway transport, next one, for example, air transport. This what? Multimodal, roadways, airways, waterways, railways, all these are more than one means of transportation is covered. We call it as multimodal transport operators. So to those operators, if you want to pay commission for payment of commission, withdrawal of foreign exchange requires CG prior approval. For that, registration certificate from Director General of Shipping is required. Getting my point? Simple ma. Abibus, Redbus, Paytm, they allow you to book the bus tickets. Correct? They provide interface services. So they charge commission on sellers or simply service providers. So we are allowing you to book tickets. We are allowing you to book your bus tickets. Getting my point? Suppose, I'm the bus owner. I'm listing my bus in Paytm. So because of Paytm, my seats are getting booked. So Paytm charge some commission. I'll pay some commission. So here, suppose if it's not Paytm, it's Alibaba. It's, it's a service provider is outside India. So payment of commission, withdrawal of foreign exchange is required. For that withdrawal of foreign exchange, registration certificate from Director General of Shipping is mandatory. Next one, remittance of hiring charges for transponders by TV channels, internet service providers. Here it is all about, telecast, sports channels, national geographical channels, if you observe, or, Netflix recording a movie outside India, but providing that movie in India. Movies, telecasting movie in India. So against that, we need to make payment. We need to make payment in what? In foreign currency. So withdrawal of foreign currency for making payment towards these people requires permission from Ministry of Information and Broadcasting, Ministry of Communication and Information Technology. Next one, container detention charges. It's like parking charges, ma. It's like a parking fees. Suppose you're going to DMart. You're parking your four-wheeler. So for each hour, for 1 hour, they charge 30 rupees. For example, that 30 rupees parking fees. So here also, when ship is going to outside India, any country, they will give some 2 days time limit for loading and unloading activities. Beyond the time period, even if you are parking your ship in their port, so they will collect detention charges. Detention charges up to prescribed rate, permission is not required. Exceeding prescribed rate, Ministry of Surface Transport permission is required. And next point, chance of getting this point is very, very high. The point is, prize money sponsorship of sports activity abroad by a person other than international, national, state level sport bodies if the amount involved exceeds $1 lakh. ICC making payment, BCCI making payment, or Tamil Nadu Sports Association, Andhra Pradesh Sports Association, all these are international bodies, national bodies, state level bodies. If these bodies are making payment, for example, man of the match award, player of the match awards, player of the series awards, for this withdrawal, if at all, if these payments are done outside India, of course, ICC not applicable, international body, yes, ICC outside, it's a non-resident, ignore. I'm talking about BCCI, I'm talking about, state level sport bodies. If they're making payments outside India for which withdrawal of foreign exchange is required, they can do it, no problem. But any person other than these bodies, for example, Tata IPL is there. This Tata IPL was conducted outside India. For example, in Australia, they conducted IPL. Player of the match award, some $1 lakh they are making payment. $1 lakh, that means it is within the limit. Therefore, RBI, CGA permission is not required. Suppose it's a $10 lakh. Now, Tata IPL, Tata company has to take approval from Ministry of Human Resources Development. that is Department of Youth Affairs and Sports. Getting my point? Other than sport bodies and payment exceeding $1 lakh, then permission is required. Remittances for membership, membership fees of Protection and Indemnity Club, P&I Club. So for getting membership of this club, if you want to withdraw foreign exchange, you can withdraw, but Ministry of Finance permission is required. Clear? So Schedule 2 also completed. Next one, Schedule 3, permitted transactions. See here, Schedule 3 deals, Schedule 3, RBI is having control over Schedule 3 transactions. But the point is, RBI is having a lot of activities. RBI is involved in a lot of tasks. So every time for carrying these transactions, if you go and stand in front of RBI, the burden over RBI, the administrative burden over RBI will be increased. So to reduce that administrative burden, what RBI is telling, for carrying these transactions, my dear individual, for carrying these transactions up to $2.5 lakh, permissions not required. Just communication with me is sufficient. You communicate with me and go and do it. That's it. But exceeding this limit, permission is required. Sir, what is the difference between communication and permission? Communication means, hey, I'm drawing $5,000 here. Permission means, sir, I need to draw $5 lakh. I'm waiting for your approval. So here I'll file application and I'll also wait for RBI approval. Getting my point, students? Everyone, I wait for RBI permission. So up to $250,000 freely permitted. Getting it? So what are those transactions? Visits to any country except Nepal and Bhutan. In Nepal and Bhutan, our currency is allowed. So withdrawal of foreign exchange is prohibited. Gift to donation, going abroad for employment, immigration, maintenance of close relatives abroad, travel expenses, medical expenses abroad. Next one, expenses in connection with medical treatment abroad. H point, a small correction you have to do. Abroad, abroad, it's studies abroad. Just make this change, studies abroad. That's it. For studies abroad and any other current account transaction up to $250,000, no need of RBI approval. But DGH points. What are those DGH points? Immigration, medical treatment abroad, studies abroad. For these three, if you had a valid proof that $2.5 lakh are not sufficient, need more than that amount. If you had evidence, if you had any proof, then you can even withdraw excess amounts even without RBI approval. Even without RBI permissions, you can withdraw amount exceeding $250,000 if you have a valid evidence. For immigration, you'll have countries of immigration certificate. Medical treatment, that institute, that hospital will issue quotation, medical treatment expenditure. Studies abroad, education university will give you quotation, fee quotation. So these will act as an evidence. In those quotations, suppose amount mentioned is $3 lakh. Now $3 lakh means it exceeds $2.5 lakh. So permission required or not required, sir? Not required, since you are having a proof. For other cases, you have to stand in a queue. You have to wait for RBI permission. Then only you can make such payments. That's it. Next one, LRS. LRS means liberalized remittance scheme. Individuals, including minors, can remit up to $250,000 per financial year. This limit is not for the lifetime. This limit is throughout the life or each financial year for both current account transactions and capital account transactions. It's not separately, for current $2.5 lakh, for capital $2.5 lakh. It's not current plus capital per individual per financial year $2.5 lakh. And this benefit of $2.5 lakh is not available to corporate firms, HUFs, trust. Why? Suppose if this benefit is allowed to the corporates, then I'll incorporate 1 million companies. I'll incorporate some 10,000 companies and I will misuse foreign currency of the country. I'll misuse foreign exchange reserves of the country. So for corporates, firms, HUFs, trusts, separate points are there. We'll see. Next one. This is also one important point, ma. Okay, chance is there, can be tested, ma. Citizens of foreign states, if they are coming to India, they are not permanent residents, they are coming to India on deputation basis. So whatever net salary they are getting in rupees, they can convert into dollars. Even though that amount is greater than 2.5 lakh dollars, they can convert it, they can send it to, they can send it that money to outside India. So simply they can remit up to net salary. That net salary, even though it is exceeding, even though it is greater than 2.5 lakh dollars, no RBI permission is required. This benefit is not available to Pakistan citizens. And person resident on India, or person resident in India on account of his employment or deputation of specified duration, the duration shall not exceed 3 years. So on contract purposes, or on project basis, sometimes foreign citizens may come to India for a period of not exceeding 3 years sometimes. Then those people are treated as residents, but they are not permanent residents. Once that project is over, they will leave the country. Now a person came to India for 2 years. His annual remuneration, for example, 50 crores rupees, 50 crore rupees. If you convert into dollars, it will be more than 2.5 lakh dollars. Can he withdraw that money for sending it to his family members outside India? Yes. For such withdrawal, even though the limit is more than 2 point, even though the amount is crossing the limit, but no worry, no tension, allowed. Next one. For entities, that is non-individuals, the following remittances by person other than individuals shall require prior approval of RBI. Just add some words here. For proper interpretation, shall require prior approval if following limits exceeded. Just sufficient. So here these transactions are allowed, A, B, C, D, these transactions are allowed. Up to limits, RBI permission is not required. But if limits exceeded, then foreign exchange, then RBI approval is required. Or else I can also do like this. Following remittances by persons other than individuals shall not require prior approval of RBI up to these limits. Exceeding the limits, RBI prior approval is required. So what are those points? Let's see. Donations. One practical question is there. Just look into that practical question. Okay, a company can donate up to 1% of foreign exchange earnings for the past 3 financial years, or 5 million USD, whichever is lower. Suppose last 3 years foreign exchange earnings, for example, $1 lakh, $2 lakh, $3 lakh. So just total it. It's $6 lakh into 1% means how much? $6,000. $6,000 or 5 million USD, whichever is lower, means $6,000. So donations up to $6,000, RBI permission is not required. Exceeding $6,000, RBI permission is required. Commission to the foreign agents. For selling residential flats, commercial plots in India, commission per transaction cannot exceed USD 25,000 or 5% of inward remittance, whichever is higher. Suppose inward remittance is, for example, $1 crore. $1 crore into 5% means how much? $5 lakh. What is the limit? 25,000 or $5 lakh, whichever is higher means $5 lakh. So payment of commission up to $5 lakh to that foreign commission agent, RBI approval is not required. But exceeding this limit, RBI prior permission is required. So other than individuals, 2.5 lakh USD limit is not applicable. Individual limits. So what is the purpose? And for each purpose, limit is there. Next one, consultancy services. You are using that consultancy services with respect to Indian infrastructure projects. Now against those services, up to 10 million USD. How much? 10 million USD per project for consultancy services. Withdrawal is allowed without RBI permission. Exceeding these limits, RBI prior permission is required. Whereas consultancy services other than infrastructure projects, a limit is 1 million USD. 1 million USD. 1 million USD per project. Payments up to 1 million USD per project for a service other than infrastructure projects is allowed. Suppose exceeding 1 million USD, you have to take prior approval of RBI. I'm not telling that above these limits payments can't be done. Above these limits also payment can be done. But prior approval of RBI is required. Can I proceed? Everyone. Next one, pre-incorporation expenses. The limit is 5% of the investment brought into India or 1 lakh USD, whichever is higher. Up to this limit, RBI approval is not required. Exceeding the limit, RBI approval is required. Okay, na. Next one, exemptions from RBI approval, ma. A person, non-resident, later become a resident. When he was a non-resident, he had one account in foreign bank. For example, HSBC, a foreign bank, he had an account. In that account, he is having $60,000. So later he came to India, he became a resident. Getting my point? Now with respect to utilization of the $60,000, is there any need to take approval from CG? Is there any approval? Is there any requirement to take approval from RBI, sir? No, not required. No approvals required for Schedule 2, Schedule 3 transactions. That means Schedule 1 already prohibited. Schedule 1 already prohibited. Next one, exchange earners foreign currency account. Other than individuals, suppose in case of branches located outside India, they got foreign earnings. They got foreign exchange earnings. So if they want that money for Schedule 2, Schedule 3 transactions, they can use it. For that, no approval is required. Of course, for these 3 transactions, approval is required even if you want to withdraw your own foreign exchange money. What are those 3 transactions? P&I club membership fees, commission to foreign agents above $25,000, pre-incorporation expenses reimbursement above 5% of the investment or $1 lakh. First case, CG prior approval. Last 2 cases, RBI prior approval required. For remaining transactions, no authorizations required. International credit card, allowed for Schedule 3 even without checking the limits. Family remittances and clubbing rules. In a family, 4 members are there. For current account transaction, you can club it 2.5 lakh USD. So total 1 million USD. That means 10 lakh USD they can withdraw for carrying current account transactions. But for carrying capital account transactions, that property should be registered both in the name of husband and wife. Suppose, for example, in a family, husband and wife are there. Each person can draw 2.5 lakh. Sir, combinedly can they draw 5 lakh, sir? Combinedly they can draw $5 lakh, provided with this $5 lakh, whatever asset they are acquiring, that asset should be registered both in the name of husband and wife. Getting it? So only joint ownership cases allowed. Next one, capital account transactions. Capital account transactions are classified into 2 categories. One is debt related transactions, other one is non-debt transactions. Debt to non-debt. Debt transactions, debt instrument related transactions, CG is taking care. Non-debt, other than debt, I'm sorry, just wait. Yeah. Debt instruments related transactions, RBI is having power to frame rules. Non-debt instruments, transactions not involving debt instruments, CG will take care of framing the rules. Just observe carefully. Capital account transactions, 2 types: debt, debt instruments, non-debt instruments. For debt instruments, RBI is having power to frame rules. For non-debt instruments, CG is having power to frame rules. Can I proceed? Next. These 2 points are also very, very important. Just give one time reading. What are those 2 points? Resident holding foreign asset, non-resident holding Indian assets. What actually section 4 is telling? What section 4 is telling? No resident is allowed to hold foreign assets, transfer foreign assets unless permitted, or unless FEMA permits, or unless RBI CG permits. Correct? But here the point is, I'm a non-resident till 1st June 2024. Up to that time, I earned some 10 million USD and all that money is there in my bank account. On 2nd June 2024, I came to India with an intention to stay in India for uncertain period. Now, obviously, from this date onwards, I'll be treated as resident. So after becoming resident, is there any obligation on me to sell all these assets, to transfer all these monies, to convert all these monies into rupees? No, you can continue to hold them. You can continue to own them, transfer them, invest them. It's up to you. Permissions not required. Similarly, 7th point, if you observe carefully, I'm a resident. When I was resident, I acquired some incomes in India. I acquired some assets in India. I incurred some liabilities in India. But I left India, I became a non-resident. Now can I continue to hold these Indian assets? Can I continue to hold these Indian assets? Obviously yes, freely permitted. Freely permitted, that's it. So you can see here, a PROI can hold, own, transfer or invest Indian currency securities. Securities while they were resident in India. Assets inherited from resident India, they can hold without any objections, permissions. Next one, capital account transactions. Schedule 1, freely permitted, permissible transactions for resident. Schedule 2, permissible transactions for non-resident. Just give one time reading, just one time. These are permitted. Okay. In case of current account transactions, you have to remember two schedules, schedule 1, schedule 2 compulsory, and all others fall in schedule 3. So for schedule 3, separate reading is not required. Schedule 1, schedule 2 you have to remember. Coming to capital account transaction, it's enough if you remember schedule 2 as well as schedule 3. This no problem at all, because other transactions comes here. Investments, foreign currency loans, transfer of immobile property, guarantees, raid, loans, overdrafts, insurance policy, capital assets abroad, remittances, derivative contracts. Simply residuary part. But you have to remember prohibited capital account transactions, freely permitted capital account transactions. Then remaining transactions comes under the second point. Getting my point, students? So freely permitted capital account transactions, loan amortization payments, depreciation of direct investments in business. Suppose, I acquired some 100 shares of Microsoft by investing $1 lakh. Stock market, every time, it is getting fluctuated. The result, it fallen to some $75,000. My investment value fallen to $75,000 because of some foreign policies, foreign country policies. There is a fall in foreign security share prices, foreign security prices. So my investment became $75,000. So here, I didn't sold anything. It's just depreciation. It's a natural thing. For this, communication with RBI, communication with CG required, sir, not at all required. Even loan amortization payments also not required, because your net worth will be increased. When your liability is getting cleared, your net worth will be increased. Next one, schedule 3, prohibited transactions. Very important, ma. Prohibited current account transactions, prohibited capital account transactions. You can expect one question from these two categories. That's it. So here also we are having LRS, ma. LRS under current account transactions for schedule 3 plus capital account transactions put together, the LRS limit is $2.5 lakh. Now, prohibitions, this prohibition is on non-residents. I'm not talking about residents, I'm talking about non-residents. They cannot withdraw, or they cannot invest their money in India out of these 5 purposes. So what are those things? They cannot invest in chit funds. They cannot make investment in nidhi companies. Chit funds not allowed. Nidhi companies not allowed. Agriculture plantation activities not allowed. Real estate business, construction of farmhouses not allowed. But developments, they are permitted. Development, townships building, roads, bridges, construction of bridges, laying the roads. These are allowed because ownership is not created. They get just revenue. That's it. They are permitted. But owing the properties, construction of farmhouses, having real estate business by non-residents, allowed or not allowed? Not allowed. TDRs, buying TDRs, trading TDRs, not allowed. These 5 are prohibited, not from resident point of view, but from non-resident point of view. Getting my point, students? Everyone. Next one, transactions with North Korea. So transactions with the North Korea, yes, requires CG approval, because these people are utilizing money for carrying nuclear weapon items, manufacturing of nuclear weapon items. So that's why without CG approval, you are not allowed to make investment. You are not allowed to make, individuals, residents are not allowed to make investment in Democratic People's Republic of Korea. What are all the existing investments are there? They should be liquidated within 180 days unless extended by the government. So 180 days time limit is given to liquidate them, sell them, get that money back to India. Getting my point, students? With this, FEMA over. Let's continue marathon with the next chapter, LLP Act 2008. The expected weightage of this chapter in your examination is 12 to 14 marks. You can also look at previous examination question paper analysis, including MTPs. In January 25 attempt from LLP, 12 marks came. September 24 attempt, 16 marks came. And May 24 attempt, objective paper is not available, only in descriptive paper, 10 marks came from LLP. And even if you observe MTPs, minimum 11 marks came from LLP. Simple chapter, scoring chapter. So don't take this chapter choice. So let's continue. What is the speciality of LLP? So to know that, just listen to me carefully. For any association, association of persons planning to start business, for them, two options are available. One is partnership form of organization. Second one is company form of organization. Both these options are having their own advantages and disadvantages. Suppose if you look at a company, the biggest advantage in company type of organization is members liability. What is the nature of members liability? It is limited. Members nature of liability is limited. Limited to the extent of unpaid value multiplied by number of shares held by them, or limited to the extent of guarantee amount they provided at the time of incorporation. And another advantage is separate legal entity. Company is separated from its members. That means company is separated from its owners. Now, for the act of company, company is liable but not members. So company can sue, company can be sued. So these are the advantages of company. But if you look at partnership, these are the disadvantages. These are the disadvantages. Suppose, what is the nature of partners liability? Unlimited. Not only unlimited, their nature of liability is joint and several. First of all, unlimited liability. You all know what is unlimited liability. So in case of dissolution of business entity, in case of closure of partnership firm, so if assets are not sufficient to discharge liabilities, suppose assets 40 lakhs, liabilities are 1 crore. Now what is the deficiency amount? 60 lakhs is the deficiency amount. The 60 lakhs deficiency, partners should contribute from their personal assets. That means liability will be extended to the personal assets of the partners. Suppose there are 3 partners, A, B, C. Now each partner should contribute how much amount? 20 lakhs. 20 lakhs from their personal assets. Suppose Mr. B became insolvent. Now loss arising from insolvency of a partner shall be borne by other partners, other solvent partners. So A should contribute extra 10 lakhs, C should contribute extra 10 lakhs. That means each and every partner is liable not only for his share but also liable for other partners' share also. That's what joint and several liability. Getting my point? And act of one partner, all other partners are responsible. In partnership firm, there is no separate legal entity. So act of one partner, all other partners are responsible. So these are the disadvantages of partnership. But if you look at advantages, the biggest advantage in partnership firm is easy to form. Easy to form. That means compliance is very low, very minimum. And the management structure is highly flexible. Management structure is highly flexible. Come on, tell me, who carry business operations in partnership firm? Partners. Who are the partners? They are owners of the partnership firm. They are the owners of the partnership. Correct? So that means there will be no delay in making decisions. Decisions can be taken very, very promptly. As and when needed, they will take decisions. That's it. But if you look at company, these two acts as biggest disadvantages. It's company comes into existence only through incorporation. For that, we need to prepare documents. We need to file documents with ROC. Getting my point? So compliance is very high compared to partnership. Next one, management to some extent it's not flexible. Not flexible. Suppose company decided to change its business operations. Company decided to start new business. Now company cannot take decisions independently. First, board of directors should call for a meeting. Should call for a general meeting. In that general meeting, members, by passing a special resolution, they can approve company to start new business. Now immediately company has to file all these forms with ROC, and company has to wait for confirmation from ROC. Then only company can start new business operations. Getting my point? So management structure is not that much flexible. So if you look at these two types of organizations, partnership, company, both had their own advantages and disadvantages. But if you observe carefully, from government point of view, company is a very, very advisable option. Why? Company comes into existence through incorporation. Every year company has to file financial statements with ROC, annual returns with ROC. So therefore transparency is possible in case of company type of organization. But if you look at small business organizations, small business organizations, they are very much worried about these complaints. They are very much very worried about filing with ROC. So that's why they will come and form partnership only. And you all know partnership registration is not mandatory. Registration is optional. Of course, certain disadvantages are there, but coming to Partnership Act, registration is optional. So therefore, for government, transparency in case of partnership is missing. So that's why government, considering the small business organizations, government decided to come up with another option which combines both the benefits of partnership and benefits of company. And that hybrid form of organization which is having advantages of partnership form and advantages of company is none other than LLP. Getting my point, students? Limited liability partnership. So this is a brief introduction about limited liability partnership. Now let's look into the material. So these dates are very important. LLP Act got notified on, come on, tell me which date? 9th January 2009. So notified date 9th January 2009. So what is the commencement date of LLP Act 2008? 9th January 2009. And Parliament gave approval to LLP bill on 12th December 2008. President gave consent on 7th January 2009. But this came into force with effect from 9th January 2009. Is it clear? Next one. In this act we are having 80 sections. No, actually 81 sections are there, but section 81 was omitted. So net we are having 80 sections and we are having 4 schedules. Remember schedule numbers. First schedule decides the rights and duties of the partners and LLP. Second schedule provides procedure for conversion of firm into LLP. Third schedule, private company into LLP. Fourth schedule, unlisted company into LLP. And administration of this act is taken care by MCA. So that means both for companies and LLPs, administrative authority or executive department is MCA, Ministry of Corporate Affairs, and the Registrar of Companies. CG has power to frame and amend LLP rules through notifications in the official gazette. An important point, Indian Partnership Act does not apply to LLPs. Since LLP is also one type of partnership firm, if LLP Act is silent with respect to any situation, so can I apply provisions of Indian Partnership Act 1932? No, never. Don't apply Indian Partnership Act provisions to LLP. Are you getting my point, students? Everyone? So in that case, what we need to follow, sir? Government will come up with clarifications. Government will issue notifications. So central government may apply provisions of Companies Act to LLP if at all needed, but provisions of Indian Partnership Act does not apply to LLP. Clear? Everyone? Next one. Concept of LLP, just now I explained, I gave you a brief introduction. It combines features of both company and partnership. Since LLP includes elements of both corporate structure and partnership structure, it is known as hybrid between a company and partnership. So in examination, they may ask you a question, LLP is a hybrid version of company and partnership. Comment. In that case, just write these 4 points. That's it. For 4 marks, writing these 4 points is sufficient. Next one, definitions. So in the entire LLP Act, wherever you see the word address, if that address word is used from partner context, then partner's residential address is the address. If it is used with respect to body corporate, address with respect to body corporate is a registered office address. Body corporate will not have residential address. Body corporates will have only registered office addresses. Clear, everyone? Next one, body corporate. Somewhat different definition. Compared with Companies Act, body corporate definition is different. How? Let's see. Body corporate means company. But in Companies Act, the definition of body corporate is not like this. Body corporate includes companies incorporated outside India. That is the definition there in Companies Act. But here coming to LLP Act, body corporate is equal to company. Come on, tell me, what is body corporate? Body corporate is equal to company, and body corporate includes LLP registered in India, LLP registered outside India, company incorporated outside India. Clear? So remember these names, remember the names. Body corporate includes LLP, whether it is Indian LLP or foreign LLP. Body corporate also includes company incorporated outside India. But body corporate excludes cooperative society. This is similar. In Companies Act also this point is there. And body corporate excludes a corporation sole. Corporation sole. Getting my point? So body corporate excludes, come on, tell me, what are those two entities excluded from body corporate? Corporation sole, cooperative societies. any other body corporate excluded by CG via notification. So tomorrow, CG may notify some other entities which will be excluded from body corporate definition. So right now, no need to remember this name. You have to remember these two names. What are those two names? Corporative society, corporation souls will not be treated as body corporates. Next one, financial year. Very, 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 very important definition. Very, very important definition. Financial year in company is different. Financial year in LLP is different. Financial year means the period from 1st day of the April to the 31st day of the March of the following year. But if LLP is incorporated after September 30th, financial year may end on March 31st of the next following year. So here, date of incorporation is a point. So date of incorporation of LLP, date of incorporation of company. Listen carefully. Date of incorporation of LLP. Is it falling after 30th September? Suppose 30th September 2025. After 30th September 2025. Then first financial year closure date. First financial year closure date will be 31st March of following financial year. That means 2027. Generally, 25-26 is the financial year. But if LLP is incorporated after, it's not on or after, it's after 30th September 25, then first financial year closure date is 31st March of following financial year, that is 31st March of 2027. In other cases, 31st March 2026 is the closure date. Other cases means, LLP is incorporated before, on or before 30th September. Clear, everyone? In companies, how it is different. In companies, incorporation is on or after 1st January. Suppose 1st January 2025. Then first financial year closure date will be 31st March of following financial year. That means 2026. Getting my point, students? Other cases, 31st March of relevant financial year. Suppose, if it is on or after 1st January 2026, then financial year closure date will be 31st March 2027. 31st March 2027. Everyone getting my point, students? So company financial year definition is different. LLP financial year definition is different. Here cutoff date is after September 30. If incorporation is after September 30, then first financial year closure date will be 31st March of following financial year. Next financial year. Next one. Foreign LLP. It's an LLP incorporated outside India, having place of business in India. That's it. LLP agreement, this is similar to partnership deed, or this is similar to MOA, AOA of the companies. So if LLP agreement is silent with respect to any point, with respect to rights and liabilities of the partners, LLP, then, you need to follow first schedule. Suppose, profit sharing ratio. So what is the profit sharing ratio? It's determined by the partners. And the determined ratio will be mentioned in LLP agreement. Suppose LLP agreement is silent on profit sharing ratio, then as per first schedule, all partners will have equal profit sharing rights. That's it. Next one, small LLP, another important definition. Out of these definitions, very, very important definitions are financial year, body corporate, financial year, body corporate, and small LLP. So what is small LLP? First of all, it should be an LLP. And contribution, nothing but, in case of company, we call it as capital, but here we call it as contribution. Contribution amount should be less than or equal to 25 lakhs or such higher amount as may be prescribed up to 5 crores. CG is having power to increase this 25 lakhs to 5 crores. But for the time being, contribution amount is 25 lakhs. And turnover as per statement of accounts and solvency is up to 40 lakhs. Or such higher amount as may be prescribed up to 50 crores. CG can increase these limits to the extent of 50 crores in future. So for the time being, what are the limits? Contribution up to 25 lakhs and it's not or and turnover up to 40 lakhs. So LLP satisfying these two conditions, it is known as small LLP. Everyone, come on, tell me the limits. 25 lakhs contribution, 40 lakhs turnover. That's it. Characteristics of LLP are very simple. LLP is a body corporate. It is having a Perpetual succession, that means continued existence. So partners may come, partners may go, but the life of the partnership, the life of LLP is not, it will not depends on the life of the partners. So death, insanity, retirement, insolvency of partners does not impact its existence. LLP can enter contracts, can hold property in its own name. Next one, of course, LLP is having separate legal entity, mutual agency. There is a difference between a partnership firm and LLP with respect to mutual agency. In case of partnership firm, every partner is an agent to other partners. But in case of LLP, partner is agent only to LLP but not to the other partners. You can see here, partners are just agents of LLP only, but not for other partners. So act of partner, LLP is liable, but not other partners. That means there is no joint and several liability concept in case of LLP. No joint and several liability in case of LLP. Is it clear? So all partners are agents to LLP. That doesn't mean the partners are agents to other partners, since we had a concept of separate legal entity. One partner's misconduct does not create joint liability for others. Important point. Next one, LLP agreement, rights and duties of partners, LLP governed by LLP agreement. If LLP agreement is silent, then follow schedule 1. Okay, now artificial legal person, correct. Common seal, LLP may have a common seal, not mandatory. Limited liability, yes, partners liability is limited to the extent of their agreed contribution. If they contribute 100% of the agreed contribution, then their liability becomes 0. Next one, management of business, business of LLP is managed by designated partners who are also partners. So partners of our LLP, few partners will be designated as DP. Simply they are designated partners. They are responsible for management of business and compliances. And minimum number of partners, how many partners should be there in LLP? Minimum 2, maximum there is no limit. Getting my point? And minimum 2 designated partners we should have. Don't do calculation like this. 2 plus 2 is equal to 4. It's wrong. Here 2 plus 2 is equal to 2 only. So what is this? Minimum 2 partners are required and minimum 2 designated partners are required. If LLP is having only 2 partners, automatically those 2 partners become designated partners. That's it. They become designated partners. So minimum 2 partners are required. Those 2 partners will be considered as designated partners. That's it. So that's why I'm telling you 2 plus 2 is equal to 2 only here. So don't come to a conclusion, mathematics wrong. No. Here the equation is 2 partners, 2 designated partners, both put together 2 partners only. Next one, LLP. Very important point, ma. Very important point. If examiner want to ask a tough question, tricky question, they will ask you like this only. One association of persons, they decided to form LLP for carrying charitable activities. Is it permitted or not permitted? Answer is not permitted. LLP must engage in lawful business with profit motive. LLP can't be formed for charitable or non-economic purposes. Next one, investigation. CG has power to investigate LLP. That's common. Next, mergers, amalgamations, compromise of LLP is also there. Conversion into LLP. Yes, firms can be converted into LLP. Private companies can be converted into LLP. Unlisted companies can be converted into unlisted public companies can be converted into LLP. So that procedure, formalities, everything is there. Documents, not manual filing. All documents are, e-filing is available. E-filing of documents is there. And foreign LLPs, yes, foreign LLPs are those incorporated outside India but having business operations in India. Foreign LLP can become a partner in an Indian LLP because foreign LLP is a body corporate. Who can become partners of LLP? Yes, individuals can become partners of LLP. Body corporates can also become partners of LLP. Clear, everyone? Advantages of LLP. If examiner, the paper setter mind is good. If you want to ask easy question, this question can also be asked. So what define simply state the advantages of LLP. Very simple. It is organized and operates based on the agreement, provides flexibility in the management operations, easy to form, partners enjoy limited liability, easy to dissolve. Can I proceed? Partners of LLP, important topic. No guaranteed question but important topic. Can I? Yes. Who can become partner of LLP? Individual body corporate can become partner in an LLP. So both individuals and body corporates are having a eligibility to become partners of LLP. But coming to disqualifications, with respect to individual, he should be of sound mind. So unsound mind people who are declared as unsound mind by competent court, they are not eligible to become partners. Undischarged insolvent, adjudicated as an insolvent, both are disqualified. Even minor cannot become partner of LLP. Minor cannot become partner of LLP. You know, there is a provision in Indian Partnership Act. Minor can be admitted for the benefits of partnership firm, but here that exemption or that allowance is not there. Minor straight away disqualified. Undischarged insolvent, adjudicated as an insolvent. Suppose, you know, insolvent means it's a stage where assets are not sufficient to discharge liabilities. Individual assets, for example, 40 lakhs, liabilities 60 lakhs. So this is the stage of insolvency. And this fellow filed an application with competent court to declare him as an insolvent, and his application is pending. So we call him as adjudicated insolvent. Suppose application processed, he was declared as insolvent, and court imposed some 2 years time period. You know, 2 years you cannot enter into any contract. You are ineligible person. You know, that means that fellow is not a discharged from the insolvency proceedings. So we call him as undischarged insolvent. So straight away, you know, tell me how many people are disqualified? 4. Minor disqualified, unsound mind disqualified, undischarged insolvent disqualified, adjudicated insolvent disqualified. Everyone. Next one, body corporates. You can see here, you know, individuals can become a partners of LLP, LLPs, companies including foreign companies, foreign LLPs, LLPs incorporated outside India, foreign companies. All these are eligible to become partners of a LLP. But remember this point, very, 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 very important point. You know, cooperative society, corporation soul cannot become partners. So from body corporate point of view, you know, these two people are disqualified. Other than individuals point of view, these two people are disqualified. Cooperative society, corporation soul. If an LLP receives capital from foreign investors, it must comply with the FDA regulations. Correct. Next one, minimum number of partners. Now this is similar to section 3 of Companies Act. Every LLP shall have at least how many partners? Minimum 2 partners. Minimum 2 partners. Suppose subsequent to incorporation, you know, number of partners fall to 1. Then, you know, law is giving a time limit of 6 months. Okay, my dear solo partner, I am giving you 6 months time to increase the number from 1 to 2. If you do this, no problem. Or else we will ignore separate legal entity, and for all the debts that are contracted by LLP after 6 months, not during 6 months, after 6 months from the date of reduction of partners, that sole partner will be personally liable for all obligations incurred by LLP after 6 months. Suppose, you know, as on date of reduction, for example, 1st April 2025, date of reduction of partners from 2 to 1, you know, partnership LLP liability 40 lakhs. 6 months completed, you know, 1st October 2025, some 60 lakhs debts are there. And it was continued 31st December 2025, ROC observed that LLP is having only one partner. By the time LLP liabilities, you know, became 1 crore. Now, if you observe carefully, extra debts contracted during this period, which period? After 6 months from the date of reduction. So, whatever the debts contracted, for example, 40 lakhs, 1 crore minus 60 lakhs, 40 lakhs. For this 40 lakhs, LLP is not liable, that sole partner is liable. Unlimited liability. Getting my point, students? Everyone. So, here important point is 6 months, during 6 months or after 6 months or after 6 months from the date of reduction. Clear? Next, section 7. Important concept. So I won't guarantee you that question will come, but important concept. Okay. So section 7, appointment and requirements of the designated partners. I told you every LLP should have how many partners? 2. And every LLP should have how many designated partners? 2. Out of 2 designated partners, 1 partner should be resident in India. You know, designated partner role in LLP is similar to director role in company. But the only difference is director need not be a member of the company. He can be a member, he can be a non-member. But designated partner, compulsory first he should be a partner. Then only he can be designated as DP, designated partner. You know, both will have one number called director identification number. Coming to LLP, we call it as designated partner identification number. But both numbers are same only. Okay, so you know, to call a person a resident in India, his period of stay during the financial year should be at least 120 days. If all partners are body corporates, you know, then 2 individuals nominated by body corporates must act as a designated partners in case of contravention. That means what? So LLP is there with one designated partner, or LLP is there with two designated partners, but these two designated partners are non-residents. Getting my point? In this case, in case of contravention, LLP punishment, 10,000 of minimum penalty. If that contravention is continuing in nature, 100 per day will be added, subject to maximum of 1 lakh. And every other partner will get a punishment, same punishment, 10,000 plus 100 per day, maximum 50,000 rupees. So here contravention means, no designated partners, or one designated partner, or no resident designated partner. That's it. Identification of designated partner. Sir, how can we identify designated partner, or how one becomes designated partner? Just go and check incorporation document. There, against designated partner names, whose names are mentioned, those people become designated partner. If nothing is mentioned, then all the partners become designated partners. Every partner shall be a designated partner. A partner may become or cease to be a designated partner as per LLP agreement. So, admission of a new partner, retirement of existing partner depends on the terms and conditions mentioned in LLP agreement. Subject to LLP agreement, a new person can become partner, or existing partner can retire from the LLP. Next one, before naming someone as a designated partner, LLP should get consent from that individual. Getting my point? And LLP shall file all the particulars of a designated partner with ROC within 30 days of appointment. A designated partner must meet prescribed conditions to be eligible. One such condition is he must possess DPIN. He must possess designated partner identification number, or else he is not qualified to act as designated partner. In case of contravention, filing with ROC, liability LLP 5,000 plus 100 per day. In case of continuing default, up to maximum of 50,000. Every designated partner 5,000 plus 100 per day, up to maximum of 25,000. You need to observe. Some cases, all partners are liable. Some cases only designated partners are liable. So you have to pay attention. Getting my point? Very simple, ma. Suppose no designated partner, all partners will get punishment. Designated partners are there. Designated partners only get punishment. That's it. That's it. Very simple to understand. Very simple to remember. No designated partner, all partners will get punishment. If there is a designated partner and LLP is not complying with LLP Act, LLP rules, then only designated partner will get punishment. So liabilities of designated partner. Let's see. Unless otherwise provided in this act, designated partner shall be responsible for LLP compliance and is liable for all the penalties imposed on LLP for non-compliance with the provisions. Is it clear? Everyone? Next one. So he is responsible for compliance with LLP Act. In case of non-compliance, he is also responsible for penalties. Next one, changes in designated partners. Of course, new partner can be admitted as designated partner. New person can become a we can appoint new designated partners, or old designated partners may retire. But whatever changes happen, the changes shall be communicated with ROC. LLP must appoint a new designated partner within 30 days of vacancy. In case of vacancy of designated partner, suppose two designated partners are required. Ram, Sham, both are designated partners. Sham died, or Sham become insolvent, or Sham become unsound mind. Now there is a vacancy in designated partner. That vacancy shall be filed within how many days? 30 days. If no designated partner is appointed, or only one designated partner is there, then all other partners are deemed to be designated partners. Accordingly, they will get punishment. What is the punishment? 10,000 rupees plus continuing contravention 100 per day will be added, subject to maximum of 1 lakh for LLP, 50,000 for every partner of such LLP. So within 30 days of vacancy, come on, appoint a new designated partner. That's it. Next one, procedure for incorporation of LLP. See, LLP is a body corporate. It comes into existence only through incorporation. Many times I told you the difference between body corporate and other companies, LLPs, is body corporate is an incorporated association. If such incorporation happens under LLP Act, it is an LLP. If such incorporation happens under Companies Act, it is a company. That's it. So body corporate is an incorporated association. So come on, let's see. Incorporation document is the most important document for LLP registration. Okay. At least 2 persons must subscribe to incorporation document for lawful business with profit motive. As I told you, association cannot form LLP for carrying charitable activities. Association can incorporate LLP only for lawful business activities with profit motive. That's it. The document must be filed electronically, e-filing of documents with whom? With a ROC having the jurisdiction where the registered office will be located, and it is supported by, incorporation documents will be supported by a declaration from a professional about compliance. So, professional advocates, CA, CMA involved in forming LLP and subscriber to incorporation, they will file a statement confirming compliance with LLP Act requirements. Next, contents of incorporation document. If you see, format, prescribed format, name of the LLP, proposed business activities, registered office address, initial partners, first partners, details of designated partners, and any other prescribed information. So this information you will fill in incorporation document. And penalty for false declaration, imprisonment up to 2 years and a fine between 10,000 and 5 lakhs. Getting my point? It's not either this or that. It's not either this or that, both imprisonment and fine. Imprisonment up to 2 years and fine minimum 10,000, maximum 5 lakhs. Incorporation by registration. Once all requirements are met, registrar will register the incorporation document, issue certificate of incorporation within 14 days of filing the application. So ROC may accept the file statement as sufficient evidence of compliance. So the subscribers means nothing but, partners to the incorporation document, professionals filing a statement confirming that LLP incorporation is as per LLP Act. ROC will consider that statement as an evidence and ROC issues certificate of incorporation. This certificate is signed by ROC, authenticated with an official stamp, official seal, and certificate is a conclusive proof regarding incorporation of LLP. Once certificate is issued, yes, LLP is said to be in existence. That's it. Conclusive evidence. So what is the conclusive evidence? Whether LLP is there or not there? Certificate of incorporation. Registered office of LLP and changes. Every LLP shall have a registered office for receiving communications and notices. A document may be served via post under a certificate of posting, registered post. So importance of registered office, as I told you in section 12 of Companies Act, CJI, remember these 3 points, CJI, all communications are addressed to registered office. Jurisdiction for filing cases against LLP is subject to registered office jurisdiction. I stands for investigation, inspection. All these investigation and inspection activities will happen at registered office. So any changes in registered office address, yes, LLP has to communicate with ROC. LLP has to file a notice with ROC with respect to change of registered office. And if LLP fails to comply with a registered office norms, it may face penalty. What is the penalty? 500 per day, maximum 50,000 penalty for LLP and its partners. Getting my point, students? Everyone? Effect of registration. After registration, LLP has following rights in its own name. Yes, it can sue, it can be sued, it can acquire properties, it can incur liabilities, it may have common sale, and it can perform only lawful acts like other body corporates. So this is also similar to section 9 of Companies Act. Section 9 of Companies Act, effect of incorporation. Here section 14, effect of incorporation. One point I want to make you sure is, LLP, nothing new ma. All the provisions you studied in Companies Act, there with small modifications, small adoptions, modifications, new chapter LLP, that's it. So no need to put extra efforts. If you're able to recap, if you're able to remember Companies Act provisions, just those provisions only applicable here also, with slight modifications regarding time limits, regarding roles. There we call directors members. Here we call designated partners. That's it. Okay. Selection of name of LLP. What kind of name, what type of name or how names shall be selected. Any guidelines? Yes. Every LLP name shall end with a limited liability partnership or LLP. And restrictions. You cannot use name which is undesirable in the opinion of central government. Undesirable name, allowed or not allowed? Not allowed. And that name shall not be identical to or similar to another LLP, another company registered trademark under Trademark Act 1999. So it should be unique and distinct. That's it. A person may apply to register in a prescribed form with a fee to reserve a name for a new LLP, name change of an existing LLP. If the registrar is satisfied that name does not violate section 15, it will be reserved. Name will be reserved for 3 months from the date of intimation. So important MCQ. So tell me, how long name of LLP shall be reserved, ma? How long? 3 months. 3 months. With respect to company name reservation, 20 days for new companies incorporation, 60 days for existing companies which are planning to change their name. Getting my point? But coming to LLP, reservation of name, the name shall be reserved for a period. The name will be reserved for a period. How many months? 3 months. That's it. Rectification of name, section 17. This is similar to section 16 of Companies Act. Section 16 of Companies Act. But there, central government, if it is of opinion that company name is similar to the name of another company, CG may issue an order. But here, application will be filed by the LLP or company. There is a slight difference is there. Just look into the material. If an LLP is inadvertently registered with a name that is identical to another LLP, similar to another LLP or company, or too similar to a registered trademark, then on application from affected LLP, company, trademark owner, CG may direct LLP to change its name within 3 months. Time period is also same. There are 3 months, here also 3 months. Time limit is also same. But here, application will be filed by whom? By the affected LLP, affected company, or the trademark owner. They will file application and CG will pass an order. Come on, rectify your name. How many months? How many months time is given to you? 3 months time is given. Within 3 months, you have to change your name. Suppose 3 months over, but they are not changing the name. Then, central government will give a fresh name. If LLP does not comply, CG will assign a new name. Registrar will issue fresh incorporation certificate. A registered trademark owner can apply for rectification within 3 years from the LLP's incorporation or name change. So this is also similar for company. So owner of registered trademark, if he want to file an application for rectification of LLP name, he should file application within 3 years. Last attempt, question came on this point with respect to company. With respect to company, a point, question came on this for 4 marks. If I'm not wrong, for 4 marks. In that question, the director contended that application should be filed within 2 years. Since time period completed, application can't be filed. And it is wrong because time limit is not 2 years. Time limit is 3 years. Today, LLP got incorporated, which is the name of LLP, which is similar to the name of registered trademark. Now, from date of incorporation onwards, owner of registered trademark will have a time period of 3 years to file an application with CG. CG may pass an order for rectification of name and LLP should comply with CG order within 3 months of CG's order. That's it. Once LLP changes its name, it shall notify the ROC within 15 days. Registrar updates the incorporation certificate. LLP should also update LLP agreement within 30 days. So within 30 days of ROC approval of the name, LLP agreement shall be updated with a new name. That's it. Of course, even LLP can change their name voluntarily despite a government mandated change. So if you look at 4th point, government gave new name. Government allotted new name to LLP. If you are not willing to accept this name, of course, you can change it voluntarily. That's it. So file an application for reservation of name and that name shall be reserved. That name will be reserved for a period up to 3 months. Okay, fine. Next one, a relationship of partners with LLP. Let's see. At the time of incorporation, persons who subscribe to incorporation document become partners. Any other person may become a partner as per LLP agreements. You know how a person can become partner of LLP? One is through subscription to incorporation document and second one is by complying LLP agreement terms and conditions, a new person may be admitted as a partner. It's like admission of a new partner. A relationship of partners. Of course, duties, rights of partners and LLP governed by LLP agreement. If LLP agreement is silent, then first schedule will apply. First schedule will apply if LLP agreement is silent on any matters. Okay, LLP agreement and any modifications to LLP agreement both shall be filed with ROC. Upon incorporation, yes, partners has to execute LLP deed and that LLP agreement shall be filed with ROC. Not only original agreement, from time to time, if they are making any modifications, that modified LLP agreement shall also be filed with ROC. Clear? Next one, changes of partners in LLP. So here you have to understand whenever partner is getting retired or whenever partner is becoming a former partner, that means, partner coming out of LLP, certain compliance LLP should follow or certain provisions LLP has to comply. Let's see one by one. Partner can leave LLP either as per LLP agreement or by giving a written notice at least 30 days to the other partners. Why 30 days notice shall be given to other partners? Meanwhile, LLP will give notice to public. LLP will give notice to all the persons connected with LLP so that from the next day onwards, from the next day, from which date? From the date of resignation onwards, act of former partner, LLP is not liable. Act of former partner, LLP is not liable. Getting my point? Suppose in LLP agreement, the duration fixed is, for example, 15 days or duration fixed is 45 days. Now follow LLP agreement. If LLP agreement is silent with respect to cessation of partnership interest, then as per Act, at least 30 days notice shall be given to the other partners, 30 days before resignation. Okay. Partner automatically ceases on death or LLP dissolution, declared as unsound mind or declared as insolvent or adjudicated insolvent. Now in these cases, notice required as or not at all required, death, notice required, unsound mind, court order is sufficient, declared insolvent or filed an application for adjudicated to be an adjudicated insolvent. Once these documents are filed with court or once court is giving an order, that's it. Express notice or implied notice not at all required. Court order itself act as a notice. But in case of, in case of retirement, notice is compulsory and that notice shall be given at least 30 days before resignation. Okay. So that means up to the 30 days, up to the date of resignation, the acts of LLP, for the acts of LLP, this partner is liable to the extent of agreed contribution. Suppose each partner agreed to contribute 40 lakhs. Okay. So far they contributed only 30 lakhs. This is agreed contribution and this is a contribution. So the difference amount 10 lakhs, each and every partner is liable in case LLP is getting liquidated and if LLP assets are not sufficient to meet LLP liabilities. Getting my point? Here also limited liability only. Limited to the extent of agreed contribution. Suppose they contributed 100%, whatever they agreed to contribute, they contributed. Then partner's liability becomes 0. A former partner is still regarded as a partner in dealings with third parties unless person has noticed that former partner has ceased to be a partner of LLP. So any person dealing with LLP should get a notice about resignation of the former partner, retirement of the former partner, or else LLP is liable for the acts of former partner. Former partner is liable for the acts of LLP. So you told that there is no concept of there is a concept of separate legal entity. So LLP is liable for its own acts. It's not former partner, no sir. Yes ma, correct only, correct. Point is correct. But if LLP assets are not sufficient to discharge liabilities, then each and every partner should contribute towards the deficiency. To what extent? To the extent of agreed contribution. In these partners, you have to consider former partner if notice is not filed, if notice is not given to the public, if notice is not filed with ROC. Notice that former partner has ceased to be a partner of LLP has been delivered to the registrar. So in both the cases, in case A or case B, former partner further liability is extinguished. Former partner further liability is extinguished. Getting my point, everyone? Okay. Obligations after exist. Cessation does not discharge the partner from any previous obligations to the LLP, other partners or third parties. Entitlements on exist. So upon exit, former partner, if available, suppose former partner already died sir or insolvent sir, then legal heir or official assignee, these people are entitled to capital contribution that was made by the partner so far, till the date of retirement or till the date of death or till the date of insolvency, whatever amount he contributed in the form of capital, for that amount he is eligible for refund. And accumulated profits after deducting any losses, in that to what extent he is eligible. So what is his share of accumulated profits? His share of accumulated profits after deducting losses, that amount he is entitled to. So simply capital plus share in accumulated profits. Share in accumulated profits. To these amounts he is eligible, he is entitled to. And a former partner has no right to interfere in LLP's management. Once he come out, once exit is over, once exit, he cannot participate in LLP management activities. Registration of changes in partners. So here changes two types, changes of partners details and resignation of partner. 2 points are covered in this section. One is changes of partner details. Partner details means partner name has been changed. Surname of partner changed. You all know a girl after getting married, surname gets changed. Yes or no? So change of name of the partner, change of address of the partner. Yes, partners shall update with LLP within 15 days. And LLP shall file a notice with registrar within 30 days if partner joins or exists, or if there is a change in name or address of the partner. That's it. Within 30 days of changes in name, changes in details of the partner, and within 30 days of admission of the partner, within 30 days of retirement of the partner, LLP shall file a notice with ROC, or else punishment only. What is the punishment? LLP and designated partners 10,000 penalty for failure to file notice. Individual partner 10,000 penalty for failure. Sir, why individual partner gets liability? Just link with first point. It's the duty of partner to update their details, update their changed details with LLP within 15 days of changes. Failure, individual partner gets punishment. What is the punishment? 10,000 penalty. And that notice shall be in prescribed form, be signed by designated partner. For new partners, yes, written consent is required. For new partners, written consent is required. Before naming someone as a partner, written consent is required. That written consent shall also be filed with ROC. If a partner believes that LLP will not file their exit notice, he may file it, they may file it themselves. That means what? So the former partner, if he is having a doubt that, LLP failed to file exit notice with ROC, then he can file it individually. Then ROC, first it will ask LLP for confirmation. If LLP confirms it, or if there is no response within 15 days, of giving intimation to LLP, then registrar assumes resignation is valid, and registrar will register the notice. Getting my point? So here, who are the filers? Filers is LLP or former partner. File notice with ROC within how many days? Within 30 days of event. Within 30 days of event. Non-compliance, LLP designated partners 10,000 penalty. Individual partner who failed to update his details, update her details with LLP, 10,000 penalty for failure. Clear? Over. Next one. Extent of liability of partners in LLP. Every partner is an agent of LLP for its business activities, but not an agent of other partners. That means act of partner, LLP is liable, but not other partners, not all other partners. So there is a mutual agency concept between partner and LLP, but not partner and other partners. Mutual agency is there between, come on, tell me, mutual agency is there between partner and LLP. Okay, next one, extent of liability of LLP. If partner acts without authority, LLP is not bound. If partner has no authority to act for LLP, or third party knew that partner had no authority and unaware that he was a partner. So in both the cases, one is partner is not having any authority to act for LLP, and third party knows about it. Partner is not having authority, but intentionally he is entering into the contract. Now third party cannot sue LLP. Third party cannot demand money from LLP. That's it. And third party is not having a knowledge that he's a partner. Third party don't know that he's acting in a partner capacity. In that case also, individual partner is liable, LLP is not liable. Okay. LLP is liable if a partner's wrongful act or omission occurs during business operations or with LLP's authority. For example, one partner who is allowed to collect amount from debtors. He collected amount from debtors and he misappropriated that money. He didn't accounted that money with LLP. He misappropriated that money. Now subsequently, can LLP demand money from debtor one more time? No. So for all wrongful acts of the partner, omissions done by the partner during business operations with eligible capacity, LLP is responsible to the outsiders. Getting my point? LLP's obligations are solely the responsibility of LLP. Liabilities of LLP shall be met out of LLP property. If not possible, then we will look into the contribution of partners. Any unpaid or any unpaid amount is there or not. Suppose, as I told you, agreed contribution 40 lakhs and contribution so far 30 lakhs. So yes, 10 lakhs liability is there. So each partner is responsible for remaining 10 lakhs. That's it. Extent of liability of partner. A partner is not personally responsible for LLP obligations just because he's a partner, but partner is personally liable for their own wrongful acts but not for the acts of other partners. Suppose here I told you, this fellow collected amount from the debtor and misappropriated that money. Now that partner is personally liable to LLP for his wrongful acts. Holding out like partner by estoppel. He is not a partner, but he makes a false representation. So because of false representation, if any third party got induced and if third party extends credit to the LLP, then LLP, which is receiving credit due to false representation, LLP is liable for the amount received to the third party. If an LLP continues using designated deceased partner name, their legal representative is not liable for LLP acts after death. After the death of designated partner, the legal representatives are not at all liable for the acts done by LLP even. Just wait. Excuse me. So the point I'm discussing with you is LLP continues using designated partner name. LLP continuing using a deceased partner name. It's not designated partner name, deceased partner name. Partner already died, but still they're using this name of the deceased partner. So it will not create any future liability on legal representatives of deceased partner. That's it. No further liability from the date of death. Unlimited liability in case of fraud. If an LLP or any partner acts to defraud creditors, partner's liability generally limited. But if partner is involved in any fraud, then that partner's liability becomes unlimited. Partner who is involving in the fraud or partner who supports other partner to commit fraud. That means committing fraud, abets to commit fraud. Abets, that means allowing other partners to do fraudulent activities. So these partners will get unlimited liability. Getting it? If an LLP knowingly carries out fraudulent business, those involved may face imprisonment up to 5 years and fine 50,000 to 5 lakhs. LLP partners, designated partner, employees involved in fraud must compensate for losses suffered by affected person. However, LLP is not liable if the fraud was committed without its knowledge. If LLP is also involved, then LLP will also get punishment, fine, penalties. That's it. Next one, whistleblowing in LLP. See, whistleblower, he is a person who supports or who cooperates during investigation proceedings. Suppose a complaint was filed against LLP. LLP was involved in some fraudulent activities. Investigation started. Now, any employee, any partner, getting my point? So, if they cooperates with investigation team, if they provide sufficient information, that means investigation team, the burden over them, the procedural formalities they need to follow can be reduced. Getting my point? Suppose, they will search for evidences. If you are giving them evidence, the time will be saved. Correct? Yes. So, for necessary cooperation, whatever information you are providing, you are treated as whistleblower. And what is the advantage to the whistleblower? Even though he is a person involved in the fraud, his punishment may be completely waived off or his punishment may be reduced. So, court or tribunal may reduce or waive any penalty for a partner or employee of an LLP if he provides useful information during investigation of LLP, that their information leads to conviction of LLP, conviction of partners, employee under this act or any other act. And suppose LLP, designated partner is threatening employee, designated partner is threatening other partner. If you provide this information, I will kill you, or I will remove you from the employment, I will suspend you. Harassment, anything, from all these things, partner will be, or, whistleblower will be protected. Whistleblower will be protected from all these, illegal or unlawful acts just because he's a whistleblower. Getting my point? So, very simple concept. My whistleblowing concept is those who provide useful information during investigation, his or her punishment either completely waived off or reduced. That's it. Partner's contribution, nothing but capital. This contribution can be either tangible, movable, immovable, intangible, any kind. But monetary form of partner's contribution shall be accounted in the books of accounts. Obligation to contribute, yes, it's obligation of every partner to contribute capital. Either it may be tangible contribution or intangible, services. I am providing services for which I am entitled to remuneration, but I am not taking remuneration. So that amount is also a contribution only. Monetary form of that contribution shall be recorded in the books of accounts. For example, I am entitled to the remuneration of 2 lakhs per month. So next to 12 months, I won't take remuneration. So that means my contribution is 12 months into 2 lakhs, 24 lakhs. So record my contribution as 24 lakhs. That's it. Amount coming, no services are coming. Employee benefit expenses. Next, important point, tricky point. In fact, tricky point. Suppose, as per LLP agreement, every partner agreed to contribute 50 lakhs. How much amount they agreed? 50 lakhs. So far, they contributed 30 lakhs only. So three partners are there. Each partner agreed to contribute 50 lakhs, but they contributed 30 lakhs. That means uncontributed amount, that means to be contributed amount is 20 lakhs. 20 lakhs into three partners, total 60 lakhs LLP can receive from the partners. Looking at this, one creditor gave loan to LLP. For example, some 40 lakhs credit he gave to LLP. Subsequently, partners of LLP modified LLP agreement. They reduced 50 lakhs agreed contribution to 30 lakhs, making their liability zero. Now, subsequently, if LLP is not paying that money, tell me whether creditor can collect amount based on original LLP agreement. Answer is yes. Yes. Creditor may enforce original obligation, not modified obligation. Original obligation against partner if he extends credit or relies on partner's obligation in the LLP agreement. So previously partners are liable to the extent of 20 lakhs. Correct? So three partners, 20 lakhs, 60 lakhs. That's why he gave a credit of 40 lakhs. Even though subsequently partners reduce their agreed contribution, but still they are liable for that amount. When? If LLP is not in a position to discharge creditor dues, then creditor may ask for dissolution of LLP, liquidation of LLP. In that case, creditor will get amount from partners because partners will contribute towards deficit, and that deficit amount, that amount so contributed will be utilized for payment of creditors. Yes, books of accounts of LLP can be maintained either on cash basis or accrual. Company only accrual, but LLP cash accrual. Compulsory double entry system. All books of accounts shall be maintained at registered office and for the prescribed period. And statement of account and solvency. Nothing but financial statements. Financial statements shall be prepared within 6 months from the end of each financial year. So 31st March, recent financial year, 31st March 2025, add 6 months, by 30th September 2025, financial statements, that means statement of account and solvency shall be prepared. This statement shall reflect the financial position as on the last date of the financial year. Balance sheet, nothing but it shall be in prescribed form and signed by designated partner. Filing with ROC. Every LLP shall file statement of account and solvency with registrar in prescribed form within 30 days. Within 30 days. Here you can see the time limit, within 30 days. So no time limit mentioned, but the time limit for filing this form is 30 days. 30 days after 30th September. Within 6 months, this document should be kept ready. From that date onwards, from 30th September onwards, 30 days time period is given for filing these statements with ROC. Audit of accounts, accounts, how audit will be conducted. CG is having power to frame rules and regulations. Also, CG is having a power to exempt certain LLPs from the audit requirement. And penalty for non-compliance of filing, ROC filing, you failed with ROC filings. So third point violated, then 100 per day, maximum 1 lakh for LLP, 100 per day, maximum 50,000 for designated partner. And next one, penalty for non-compliance. That means, you fail to comply 1, you fail to comply 2. 1 and 2 non-compliance, LLP 25,000 up to 5 lakhs. Every designated partner, minimum 10,000 up to 1 lakh rupee. Getting my point? Two penalties are there. One is non-compliance of filing with registrar. Just wait. Yeah, non-compliance of filing with registrar. Other one is non-compliance with 1 and 2 points. Can I proceed? Accounting and auditing standards. CG in consultation with NFRA under section 132 may prescribe accounting standards, may prescribe auditing standards as recommended by ICAI. So financial statements preparation based on accounting standards, who will prescribe? CG prescribe. CG get recommendation from NFRA. NFRA get recommendation from ICAI. That's it. Annual return. Time limit for filing annual return is very important. 60 days of the financial year closure. Every LLP shall file an annual return with the registrar within 60 days of the financial year closure in the prescribed form and manner along with prescribed fees. If the financial year closes on 31st March 2022, then last date to file annual return is 30th May 2022. Come on, tell me, what is the time limit for filing statement of accounts and solvency? 30 days from 30th September. And what is the time limit for filing annual return? 60 days from the closure of financial year. Penalty for non-filing, LLP 100 per day up to 1 lakh. Designated partner 100 per day up to 50,000. Next, inspection of documents. Incorporation document, partner details, changes, statement of account and solvency, annual return filed with ROC shall be available for inspection. Yes, just by paying 100 rupees, you can download this information from mca.gov.in website. Is it clear? Next one, penalty for false statements. Any statement you file with ROC, if it contains false information, false statements, then punishment, imprisonment up to 2 years and fine 1 lakh to 5 lakhs. That's it. Next one, power of registrar to obtain information. So if ROC is of opinion that, or if ROC came to a conclusion that, LLP not filed relevant information, prescribed information with ROC, then registrar may inquire any person, may ask questions and may get answers to those questions. Registrar can make any person to make declarations and make any person to provide information in writing within a reasonable period. And if that person, he may be a partner or a former partner, or he may be an employee, or he may be a designated partner. If these people are not following ROC directions, if they fail to provide required information, then registrar, and if they fail to provide information, or they provided information but ROC is not satisfied with that information, then registrar may order them to appear before them. Registrar may order them, someone means the ROC may order that person to appear before him means registrar, or an inspector, or any public officer designated by the registrar. Like court issuing summons for further investigation, for further further inquiry, court may issue summons. Here also registrar may issue summons, making them to appear before a public officer, inspector. Why? To collect information. That's it. Anyone complying, anyone fails to comply with ROC summons, the fine will be 2,000 to 25,000. Minimum fine 2,000, maximum fine 25,000. Clear? So this section is all about, ROC, if at all needed, it can get additional information from the persons connected with LLP. If these people are not filing information, or filed information is not satisfactory, ROC issue an order to appear them. Issue an order. So ordering them to appear before ROC. Failure to comply with ROC summons, penalty 2,000 to 25,000. Compounding of offenses. Compounding of offenses, nothing but compromise. Simply compromise. Getting it? But this compounding of offenses, the biggest advantage is you can avoid a lengthy court proceedings. You can avoid, lengthy legal proceedings. So here you will come before authority and you will accept your mistake. Sir, yes sir, I committed offense, sir. I committed offense. So it's like, self-confirmation, self-affirmation. So no need of this detailed, lengthy legal proceedings, sir. I'm admitting my mistake. So you please punish me. That's it. So that means, even without compounding of offenses also you get punishment. But the advantage of having this section is you can avoid detailed lengthy legal proceedings. That's it. Getting it? Or else what happens? Every time whenever authority is calling you, whenever authority is summoning you, you need to appear before authority. And you need to give reply. You need to answer to the authority. So it goes on. You are unable to, you can't concentrate. You won't get time to concentrate on business operations. So that's why. So one option is given to you. You can admit your offenses and all the detailed lengthy legal proceedings will be stopped. Getting my point? But this benefit of compounding of offenses is available only to those offenses where fine is only the punishment. Where fine is only the punishment. Suppose you committed one offense where fine plus imprisonment is there, or only imprisonment is there. In these cases, section 39, compounding of offenses is not allowed. Compounding of offenses is allowed only for those offenses where fine is the punishment. That's it. So punishable with fine only, offenses can be compounded. And minimum punishment is minimum fine specified in that section. Maximum fine is maximum fine specified in that section with respect to that offense. Limitations on compounding, same offense cannot be compounded once again within 3 years. That means once an offense is compounded, if you commit same offense within the next 3 years, subsequent For subsequent offense, compounding allowed or not allowed? Not allowed. If a second or subsequent offense occurs after 3 years of compounding previous offense, then we will consider this second as offense as first offense. So once again compounding benefit is given. Very simple ma. Once an offense is compounded, same offense if you commit within next 3 years, can you take privilege of section 39? No. Sir, 3 years expired, sir. 4th year of compounding, I committed same offense, sir. Okay, once again you are eligible for compounding. For that, application shall be filed with ROC. ROC will forward it to the RD. So, RD is having authority to compound your offenses. Getting my point? So, but application shall be filed with ROC. ROC forwards them to RD along with ROC comments. Next one, if an offense is compounded, ROC must be informed within 7 days. That fellow whose offense got compounded, that fellow has to communicate with ROC within 7 days of compounding. If an offense is compounded before prosecution, prosecution shall not be initiated. Suppose it is ongoing prosecutions are already, court issued a summons, court is gathering evidences, court is calling for witness, already ongoing prosecutions, sir. Then ROC must inform the court in writing and the offender shall be discharged. That means court will cancel the case. Court will cancel the case. That's it. RD may order an LLP's partner, designated partner employee to file or register returns, accounts, documents within a specified time with the required fees or additional fees. That means, you committed an offense, right? Now resolve that offense. Nullify that offense. Or else what happens, if you fail to comply with the regional director's order, you will get punishment, which is very severe punishment. So your punishment will be extended to 2 times of the respective section maximum fine. Suppose maximum fine is 25,000. Under compounding of offenses also, you are liable to pay 25,000 only, maximum 25,000 only. But if you fail to comply with a regional director order, then your punishment will be twice of the maximum fine prescribed in that section. That means 50,000. Everyone. Next one, assignment and transfer of partnership rights. Assignment and transfer of partnership rights. Assignment and transfer means what? Suppose, I'm a partner in one LLP. I need some funds. I'm facing cash crunch. I need some loan. I went to SBI. I told, yes, I'm a partner in that LLP. I can assign this share, my ownership share, in favor of you. You just give me some money as advance. Until I pay that amount, until I repay that loan amount, whatever, LLP is distributing profits, that SBI, that loan vendor will get share in the profits. Getting my point? He's assigning. So I'm transferring my interest to that fellow. I'm not transferring ownership, just I'm transferring my interest. It's like a charge, ma. It's like a charge. Suppose if I want to sell my ownership, I need to take consent from other partners. I need to comply with LLP agreement. Then only what happens? That fellow who is paying money to me, that fellow becomes partner. That fellow will exercise all the rights like other partners do. But if he is not admitting as a partner, he just enjoys share in profits. He will not get any management rights. A partner's right to share in profits and losses to receive distributions as per LLP agreement is transferable either fully or partially. The transfer of rights does not apply by itself, disassociation of partner, dissolution of LLP. That means, I'm assigning my interest in favor of SBI, or I'm selling my interest to my friend, for example, Mr. Ramu. So that doesn't mean, LLP is dissolved. That doesn't mean LLP is disassociated. LLP is having a continued existence, perpetual succession is there. Transferee or assignee of the partner's rights cannot participate in management, cannot access LLP transaction information by virtue of transfer alone. Getting my point? Since transfer happened, I transferred my ownership to another person. That doesn't mean he will get all the rights like other partners. Of course, I'm telling you, he may get rights like other partners only if admission of partner take place. If his name is recorded as a partner in LLP agreement, then, he can exercise all the rights like other partners. But until then, he is like a vendor. He is like a creditor. He is entitled to all the shares of the distributions, share of profits. That's it. Beyond that, no right. Can't participate in management decision-making, meetings. Effect of conversion of firms into LLP. Schedule 2 is telling that firm can be converted into LLP. Schedule 3, private company into LLP. Schedule 4, unlisted public company into LLP. So following these schedules, entity can be converted into LLP. But the point is, you have to file documents with ROC. ROC register the submitted documents and issue certificate of registration. Then only LLP is officially said to be registered. And within 15 days of conversion, within 15 days of registration, LLP must inform relevant authorities. If it is a partnership firm which got converted into LLP, it has to communicate with registrar of firms. If it is a private company or unlisted public company, it has to communicate with ROC with respect to conversion. Therefore, previous details like partnership firm details or private company details, unlisted public company details will be closed. From the date of, after conversion, partners, shareholders of partners of partnership firm, shareholders of company becomes partners of LLP. From the date of registration certificate, conversion effects will be specified in the respective schedules. And from the registration date, LLP will exist with the name stated in the certificate. Transfer assets and liabilities. Transfer assets and liabilities. All the assets and liabilities of a firm becomes assets and liabilities of LLP. Private company assets becomes LLP assets. Private company liabilities become LLP liabilities. Automatic transfer. Order itself is sufficient. Certificate of registration itself is sufficient. So automatical transfer, transfer is automatically completed. No additional assurance is required. Separate agreement, transferring assets from company to LLP. Separate agreements required or not at all required. Certificate of registration issued by ROC is sufficient. That's it. All assets and liabilities of a firm or company becomes assets and liabilities of LLP. The firm or company shall be deemed dissolved and removed from the records of the registrar of firms or ROC. Next one, difficult concept only, that is compromise arrangements. Here one small correction you have to make, small correction, that is if majority of partners representing, okay, wait, it's not majority of partners, majority of persons, brackets you write partner or creditor, majority of persons representing, then continue 3/4 in the value, now it will be continued. Just listen carefully. First of all, why compromise or arrangement comes into the picture. There is a dispute between LLP and creditors, or there may be a dispute between LLP and partners. So the dispute is, for example, LLP borrowed 4 crores from SBI. Right now it is not in a position to repay that amount, and LLP is requesting for some internal reconstruction, like we can't pay this 4 crores, we can't pay interest accumulated on this loan, so please waive off the interest, and remaining amount also 4 crores is there, right? I can't repay 4 crores, I can pay you 2 crores, like settlement. LLP is asking for settlement. So then how this dispute will be compromised is all about section 60. Getting my point? So compromise or arrangement may be proposed between LLP and its creditors, LLP and its partners. So who can file application with the tribunal? First of all, who is having authority to pass compromise order or arrangement order? Tribunal. So for that, either LLP or creditor or partner must file an application with tribunal. And if that LLP is in a position, if it is in a situation getting wound up, then liquidator may file an application with tribunal. Suppose LLP, there is a deficit, that means assets less than liabilities, the deficit is 40 lakhs. Each and every partner should contribute 10 lakhs, but those partners are not contributing this amount. Then definitely there is a dispute. We can tell that there is a dispute between partners. So here on behalf of LLP, liquidator will file an application with tribunal, and tribunal may order for a meeting of the creditors or may order for the meeting of partners. In that meeting, majority of the persons, majority of the partners or majority of the creditors, majority means what? More than 1/2, representing 3/4 in value. Suppose 4 crores loan amount. For example, 10 people gave loan, 10 persons gave loan of 4 crores to the LLP. Example, listen carefully, listen. Now majority of these persons means more than half, that means 6 persons. They should represent 3/4 of the value of the creditors. 3/4 of the value, 3/4 means 3 crores. So 6 persons representing 3 crores dues. If they give approval for compromise, then tribunal orders for compromise. So when tribunal orders for compromise, when it gets requisite approval. What is that requisite approval? majority of the persons representing 3/4 of the value, if they give approval, tribunal orders for compromise or else no compromise. And the tribunal, whatever order tribunal is passing, it is binding on all the creditors, partners, LLP. If LLP is being wound up, liquidator and contributories. Here contributories are nothing but partners. Until LLP is in existence, we call them as partners. If LLP, dissolution started, winding up started, now partners, we won't call them as partners, we call them as contributories. So tribunal will not approve the compromise unless LLP or applicant discloses all the material facts, including latest balance sheet of the LLP, financial position of the LLP, any ongoing investigation proceedings, everything should be updated. Filing with registrar. LLP must file with tribunal order with ROC within 30 days. The order takes effect only after filing. So whatever order tribunal passes, it is the duty of LLP to register with ROC within 30 days. Next, penalty for non-compliance. If LLP fails to file the order within 30 days, then LLP penalty 10,000 plus 100 per day up to 1 lakh. Designated partner 10,000 plus 100 per day up to 50,000. This is the punishment. And tribunal may also impose, stay proceedings, stay on the legal proceedings. Suppose, creditors already filed suit on LLP in court. So tribunal order, it imposes stay on the court proceedings. So temporarily legal proceedings will be suspended. That's it. Next one, whatever order tribunal passed with respect to compromise or arrangement, not only passing that order, tribunal is having a right to enforce that order. Tribunal can supervise whether order is implementing or not, whether the compromise or arrangement is as per order or not. If at all needed, some modifications also tribunal may allow. But if tribunal is satisfied that compromise or arrangement sanctioned under section 60 can't be worked satisfactorily with or without modifications, it may either on its own motion or an application filed by affected person may order for winding up of LLP. Getting the point, ma? So if tribunal comes to a conclusion that compromise or arrangement sanctioned under 60 can't be worked either on its own motion or when an application is filed by the affected person, tribunal will order for winding up of the LLP. Next one, reconstruction or amalgamation of LLP. So that means, one LLP acquires another LLP. So this LLP is getting sold to one LLP. If an application is made under section 60 for a compromise or arrangement, it is shown that proposal is for reconstruction of LLP or amalgamation of 2 or more LLPs. The properties, undertaking is nothing but property. Property liabilities of transferor LLP will be transferred to transferee LLP. Tribunal's order for implementation. Tribunal may provide for transfer of all or part of undertakings, properties, liabilities of the transferor LLP to transferee LLP. That means, for example, A LLP, B LLP. A LLP is acquiring B LLP. Now B is known as transferor, A is known as transferee. All the assets of transferor LLP will become assets of transferee LLP. And whatever pending proceedings are there against B LLP, all those pending proceedings will be shifted to transferee LLP. Either transferor LLP may be closed, dissolution may happen even without winding up because already all assets got transferred. Now, no need of liquidation, directly order for dissolution. That LLP gets dissolved. Provision for dissenting persons based on tribunal directions and incidental, consequential, supplemental matters as and necessary, tribunal may pass it. Next one, conditions for amalgamation. Tribunal will not sanction the amalgamation under winding up unless registrar submits a report confirming that LLP affairs were not conducted prejudicial. Official liquidator examines LLP records and reports that affairs were not prejudicial. Simply, affairs are not having negative impact. So there is no negative impact on the partners, on the public. If this condition is satisfied, then tribunal may order for amalgamation. Suppose sometimes what happens, to avoid taxes, for tax evasion, simply to cheat creditors, they will merge one LLP with another LLP. Merger may happen, amalgamation may happen. So here, the clear-cut intention, the objective of amalgamation is to defraud creditors or to defraud government by avoiding taxes. So there, tribunal will not sanction amalgamation. Tribunal will not order for amalgamation. It will stop amalgamation. It will stop winding up. That's it. If an order directs transfer of property or liabilities, the property will vest in transferee LLP and liabilities will become those of the transferee LLP. The property will be free of any charge if order specifies that charge is to cease to have effect. Within 30 days of order, LLP must file a certified copy with the registrar for the registration. So whatever order passed by the tribunal, file a copy with ROC. If LLP fails to file the tribunal order within 30 days, then penalty. What is the penalty for LLP? 10,000 plus 100 per day up to 1 lakh for LLP. Designated partner 10,000 plus 100 per day up to 50,000. Next one, last attempt this point tested ma. Just one time, just look at this point one time. Circumstances in which LLP may be wound up by tribunal. So tribunal is having an order. Tribunal is having a power to order for winding up of LLP. So when tribunal will pass such orders? When will tribunal pass such orders? In these 5 cases, tribunal may pass such orders. What are those cases? LLP itself decides to wound up by tribunal. LLP is filing application with tribunal. Come on, sir, liquidate us. Now tribunal may pass an order for winding up of LLP. Number of partners fall below 2 and LLP is carrying business operations more than 6 months. So from the 6 months, after 6 months from the date of reduction of partners, yes, LLP will be wind up by the tribunal order. LLP has acted against sovereignty, integrity of India, security of the state or public order. LLP is carrying activities which affects national security, national sovereignty. So it is creating some fake propaganda. It is creating disputes between two religion people, two community people. Getting my point? So in those cases also, tribunal may pass an order for winding up of LLP. If LLP fails to file financials, financial statements, nothing but statement of account and solvency or annual return with ROC for 5 consecutive financial years. 5 consecutive financial years. If LLP fails to file accounts, annual returns, then tribunal is having a power to pass an order for winding up of LLP. And tribunal deems fit just and equitable. Suppose there is a deadlock situation. Suppose there are 4 partners, 2 partners are in favor of proposal, 2 partners against to proposal, and there is no unity among these partners. No unity among these partners. In that case, what tribunal can do? Based on just and equitable grounds, tribunal may order for winding up of the LLP. Next one, yes, partner can do business with LLP, no problem. Partner can do business, can conduct business operations with LLP. A partner can earn profits with the transactions with LLP because LLP is a separate body corporate. It's a separate legal entity, correct? Next one, application of the provisions of Companies Act. To apply provisions of Companies Act to LLP, first of all, central government may prepare a draft bill which will be presented in both the houses of the parliament. A draft notification shall be laid before both the houses of the parliament for 30 days. Within that 30 days, if parliament give approval, then they can apply provisions of Companies Act to LLP. Suppose both the houses disapprove or modify the notification, then if they disapprove the notification, then central government cannot publish that notification. If they modify the notification, then that modified notification shall be applied. Modified notification shall be applied. Next one, payment of additional fees. All filing should be done within the prescribed period. Suppose if the due date is over, for the additional period, for the delay period, yes, ROC can collect additional fees from you. Next one, enhanced punishment. For repetition of offenses, repetitive offenses, you committed offense, I punished you. Again, you are committing same offense. In that case, imprisonment will be enforced as it is. Suppose imprisonment 2 years as it is, but fine can be increased to 2 times of the maximum fine. For repetitive offenses, for second or subsequent offenses, the fine will be enhanced penalty. The enhanced fine will be twice the original amount. For first offense, you paid 25,000, right? Maximum 25,000 you paid. Now for second offense, come on, pay 50,000. Imprisonment, same. Imprisonment, there is no change. Next, if your time is too good, you can get a question, 5 marks question asking differences between LLP and partnership, asking differences between LLP and company. Come on, remember some 10 points, write those 10 points, 5 marks in your hands. Just remember these bases, LLP Act, Partnership, Indian Partnership Act, LLP body corporate, partnership firm, not a body corporate. LLP is having separate legal entity, partnership no. Creation requires incorporation, but creation of partnership firm that doesn't require registration. Registration is just voluntary, whereas LLP registration is mandatory. Perpetual succession is present in LLP, no perpetual succession in partnership. Name of LLP ends with limited liability partnership or LLP as suffix, but there is no such guidelines with respect to partnership. Liability of partners is limited to the extent of agreed contribution, whereas partnership liability unlimited. Mutual agency, here partner can bind LLP but not other partners, whereas here in partnership every partner can bind firm as well as other partners. Minimum 2 designated partners are required, here no designated partners. Common seal, here there is option is there, but here there is no such option. Common seal option is not there. Legal compliances, only DP are responsible, whereas partnership firm all partners are responsible. Annual filing of documents, only 2 documents must, statement of accounts, annual returns, but here there is no such requirements. That's why I told you here transparency is not there, but here better transparency is there. Foreign partnership, foreign nationals can become partner in LLP, but foreign nationals cannot become partners in partnership. So this point remember, foreign nationals can be admitted as partners in LLP but cannot be admitted as partners in partnership. Minors cannot be admitted to the benefits of LLP, whereas minor can be admitted to the benefits of general partnership firms. Very simple. Next one, LLP versus limited liability company. LLP Act, Companies Act. Here owners are partners, here owners are members. LLP it's a governance is decided by LLP agreement or first schedule, but here MOA, AOA statute. Name ends with LLP, here name ends with limited or private limited. Minimum 2 partners required, maximum no limit. For private company, minimum 2 members, maximum 200 members. Public company, minimum 7 members, maximum no limit. Liability of the members, yes. Liability of the owners in case of LLP, limited to the agreed contribution. Here limited to the unpaid amount. Management is taken care by designated partners. Here management is taken care by board of directors. And how many minimum designated partners required? 2. But coming to company, private company minimum 2 directors, public company minimum 3 directors. One more difference I can add here. Company can be for charitable objectives as well as profit objectives. Company can have charitable objectives or company can have profitable objectives, whereas LLP should have only profit objectives. LLPs are allowed only for carrying lawful business operations. This is one more difference. Getting my point, students? So with this, LLP revision completed. Let's continue marathon with the next chapter, General Clauses Act 1897. The expected weightage of this chapter in your examination is 14 marks. As you can see in previous attempt question paper analysis, in January 25 attempt, 14 marks came from this chapter. September 24 attempt, 14 marks came from this chapter. May 24 attempt, objective paper is not available and only in descriptive paper, 8 marks came from this chapter. With this, it is very clear. You can expect 2 descriptive questions from this chapter, each carries 4 marks. And 3 multiple choice questions, each carries 2 marks. So the combined weightage of descriptive portion and objective portion of this chapter is 14 marks. Small chapter, simple chapter and scoring chapter. So don't take this chapter choice. So next 1 hour 15 minutes, you just stay with me. You feel comfortable with this chapter. Clear? This chapter is of 2 parts. Part 1, definitions for certain terms. Part 2, general principles of interpretation. Part 1, definitions. Part 2, general principles of interpretation. The speciality of this chapter is, this is an act to study general clauses. First of all, tell me, what is the main objective of having section 2 in all the central acts? What is section 2? Definitions. So what is the objective of having definitions under section 2? First of all, what is the main reason of having definitions? Definitions define some technical words, which we use them throughout the statute. So if we had definition under section 2, we can avoid repetition of explaining those words wherever they occurs. As a result, language of the law can be reduced. Getting it? Now, it is not possible to define all general words in all central acts. So to define these general words, lawmaker came up with one more act. That act is General Clauses Act 1897. For example, we had a definition to government company in Companies Act, but we had no definition to government. We had a definition to financial year in a Companies Act, but we had no definition to year. We had no definition to month. We had no definition to day. For all these are general words, government, year, month, day, declaration, affidavit. All these general words are very common in central acts. If we start defining all these words in all central acts, what happens? Language of all these central acts can be increased. And moreover, we should provide uniformity of these words. So one act is defining one word differently, another act is defining the same word in different manner, uniformity of expression will be lost. So to avoid all these situations, to shorten the language of central acts and to provide uniformity of expressions used in all these central acts, yes, General Clauses Act 1897 came into the picture. So General Clauses Act 1897 enacted on 11th March 1897. So what is the commencement date of General Clauses Act? 11th March 1897. To consolidate and extend General Clauses Act 1868-1887. So our first General Clauses Act is General Clauses Act 1868 and second General Clauses Act 1887. So we consolidated all these laws and we are bringing these laws into force under new General Clauses Act 1897. The Act contains definitions for certain terms and general principles of interpretation. These general definitions apply to all central acts and regulations unless specific act or regulation defines the term differently or the context requires otherwise. For example, you take financial year definition. General Clauses Act is telling that financial year means it starts from 1st April, ends with 31st March. Whereas if you take LLP, first financial year of LLP, it depends on date of incorporation. If date of incorporation is after 30th September, after 30th September, then financial closure date will be 31st March of following financial year. Now there is a conflict between General Clauses Act and LLP with respect to financial year definition. Now which definition I should follow? Very simple. For LLPs, LLP Act is special law, special act. If there is a conflict between special provision and general provision, always follow special provision. So with respect to LLPs, following LLP Act, apply definition of financial year as per LLP Act. That's it. The Act helps in cases where a clear definitions are absent in specific laws and resolves conflict between pre-constitutional laws, post-constitutional laws. We got constitution on 26th January 1950. So before that constitution, what are all the laws we are having? We call them as pre-constitutional laws. For example, Chartered Accountants Act, Indian Contract Act, Sale of Goods Act, Indian Partnership Act, Negotiable Instruments Act, all these are pre-constitutional laws. Post-constitutional laws, for example, Companies Act, LLP Act, Income Tax Act, etc. It provides guidance on conflicting provisions, clarifies legislative intent, intention of the lawmaker or spirit of the law, that's it, and distinguishes laws based on their commencement and enforcement to prevent uncertainty. Objectives of General Clauses Act 1897, very, very, very important. Objects of General Clauses Act can be tested for 4 marks. So 4 points you have to remember and 4 points you have to write in examination. First object is shorten the language of central acts. When general definitions were defined under General Clauses Act, no need to define them in other central acts. So language of central acts can be shortened. Provide uniformity of expression. Here expression is nothing but words, phrases used in central acts by giving definitions for commonly used terms. So once defining a general term under General Clauses Act, same definition, same meaning will apply to all central acts. Uniformity of expressions is possible. State explicitly certain convenient rules for construction and interpretation of central acts. See, students get confused between construction and interpretation. Both are similar, but there is a thin line of difference. The thin line of difference is interpretation means understanding the provision by reading the provision. Construction means here simple reading will not give desired meaning. Sometimes it may give desired meaning, sometimes it may give undesired meaning. So ignoring undesired meanings, applying desired meaning, this process is known as construction. For example, if you ask me Section 3 of Companies Act, a company may be formed for lawful purpose. There the word may is used. Company may be formed for lawful purpose. Now the readers of this provision, they can also interpret this provision like this. Company may also be formed for unlawful purpose. So one provision giving 2 meanings, desired meaning, undesired meaning. Ignoring undesired meaning and drawing desired meaning, giving attention to the desired meaning, applying the desired meaning, the total process is known as construction. So very simple, where interpretation is not giving desired result, we go with construction. Simply interpretation, where interpretation ends, construction starts or construction begins. That's it. So, this chapter provides convenient rules of interpretation and construction. And this chapter provides a guard against slips and oversights by importing certain common form clauses which otherwise ought to be inserted in every central act. While drafting the law, a lawmaker with one intention, he will draft the law. And when a person is reading the law with the same intention, he need to read the law, he need to apply the law. Or else what happens if intention gets changed? With different intention, if we read provision, we get a different meaning. Getting my point? See, lawmaker is a person. With one intention, he draft the law. So some slips and some oversights are possible. So to provide guard against these slips and oversights, yes, General Clauses Act is there. It provides convenient rules for interpretation and construction. What it tells, so what might be the intent of the legislature while drafting the law? You just follow that intent. Accordingly, derive the meaning, accordingly, apply the meaning. That's it. Purpose of the act. It consolidates various interpretation rules and legal principles into a single statute. Correct. All general principles of construction you will find under this chapter. This act eliminates unnecessary repetition in legal language. Any definition principles laid out in General Clauses Act automatically applies to all relevant central statutes, central acts. Next one, applicability of General Clauses Act. Remember, General Clauses Act will never have its own territorial extent. Its territorial extent depends on Central Acts. If Central Act is applicable to whole of India, then General Clauses Act with respect to that Central Act is applicable to whole of India. Suppose if Central Act is not applicable to particular region, particular state, then General Clauses Act with reference to Central Acts not applicable to that region or that states. Getting my point? Suppose to union territories, one act is not applicable. Now General Clauses Act with respect to that Central Act not applicable to union territories. That's it. Part of Central Acts. This act is considered part of every Central Act. If Central Act applies to a region, General Clauses Act will also apply for the interpretation of Central Acts to that region. Acts covered, Central Acts means what? Act of Indian Parliament. After Constitution, Act of Indian Parliament is Central Act. Before Constitution, but after independence. After independence, before Constitution, Acts of Dominion Legislature. And before independence, acts passed before Constitution by Governor General in Council or Governor General acting in legislative capacity. Examples, if you want, Indian Parliament, Income Tax Act you take, LLP Act you take, Dominion Legislature Acts, you can take a Chartered Accountants Act, you can take a Banking Regulation Act. Next one, acts passed before Constitution, Governor General in Council, you can take Indian Contract Act, you can take this chapter only, General Clauses Act, you can also take Sale of Goods Act, Indian Partnership Act, etc. Next one, while interpreting the Constitution, if at all help is needed, you can also take help of General Clauses Act while interpreting the Constitution. Okay, na? Next one, basic understanding of the legislation. Preamble. Important. No guarantee that this point will come, but important topic. Preamble. What is the main theme of preamble? Why preamble is there? What is the reason of existence of preamble? You can see here. Preamble defines scope of the act, object of the act, purpose of the act. Scope, object and purpose of the act is there in preamble. Preamble is a primary source for understanding, interpreting the legislator intention behind the act. If a provision in the act is ambiguous, the preamble can be used to aid in its interpretation. For example, if you take Negotiable Instruments Act, the preamble is act to define and amend the law relating to promissory notes, bills of exchange, checks. Generally, negotiable instrument means, it's an instrument which is capable of creating rights and obligations on the parties thereto. If it is freely transferable, we call it as negotiable instrument. So now, looking at the word negotiable instrument, sometimes we get, we think that hundis. Next one, we think that, bill of lading, railway receipts. These are also known as, shares, warrant, bearer debenture. These will also become a negotiable instruments. But whether this act applicable to these bearer instruments, no. Why? Preamble, it is very clear. Preamble is telling that this act, which act? Negotiable Instrument Act is applicable only to the promissory notes, bills of exchange, checks. Similarly, Companies Act, this act is applicable only to the companies. So this act is not applicable to partnership firms, not applicable to sole proprietorship firms. Getting my point? Everyone. So any provision in the act is ambiguous, then refer to preamble so that you will get an aid to interpretation. You can take a support of valid interpretation. Preamble is a part of enactment and can be legitimately used to interpret it. However, preamble cannot override the plain provisions of the act. However, it can be brought in as aid to construction if the statute's wording is unclear. Suppose section 464. Section 464, it talks about partnership firms. One section, it talks about illegal association, it talks about partnership firm. So when specifically word partnership is used in Companies Act, that provision is applicable only to the partnership forms. That's it. So since preamble is telling about only companies, no sir, so I will not apply that section to partnership form. Is it valid conclusion? No, 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 no. If a particular provision is telling that yes, we are extending these provisions to partnership form, then those provisions will be extended to partnership form. Just by looking at preamble, don't stop applying those provisions to partnership form. That is the point. Everyone. So if a word or phrase has multiple meanings, the preamble can clarify which meaning was intended. So provision, if provision is ambiguous, not clear, refer to preamble, take preamble support and derive conclusion. Come to conclusion. But if there is a conflict between provision and preamble, don't apply preamble, follow provision as it is. That's it. Next one, act. Simply, when bill is passed by both the houses of the parliament, consented by president, it becomes act. So definition, what is the main objective of definition? It avoids repetitive explanation of the word throughout the act. If word is not defined in the act, its meaning is to be taken from general clauses act. Okay. So word company is defined in Companies Act. Word security is defined in Securities Contract Regulation Act. The word affidavit is defined in General Clauses Act. These three words are commonly used in Companies Act. Now each and every word is having their meanings. Company definition is there in Companies Act. Security definition is there in Security Contract Regulation Act. Affidavit definition is there in General Clauses Act, because Companies Act is silent with respect to word affidavit. Next one, definitions classified into these three categories. Some definitions starts with word means. So those definitions are known as exhaustive definition. Exhaustive, complete, which exactly define a term without extending its meaning. Example, company. Company means company incorporated under Companies Act 2013 or previous company law. That's it. So complete definition you will find. Nothing will be added, nothing will be deleted. So it exactly defines the term. Includes, used in inclusive definitions which extend the meaning of a term beyond what is stated. Example, debenture. Debenture includes debenture stock, bonds, any instrument evidencing debt to the company. Remember, so here we are not defining the term. In fact, we are providing the list of items covered by this definition. And some definitions will have words means and includes, used when a definition is both exhaustive and inclusive. Example, share. Share means share in the share capital of the company and includes stock. Similarly, prospectus you take. Prospectus means any document described and issued as a prospectus, and also includes shell prospectus, red herring prospectus, deemed prospectus. Okay, so means and includes. Here also the scope of the definition is restrictive in nature, complete and restrictive. Apply to and include, extensive definitions indicating a broader meaning. Example, body corporate. Here also, body corporate, we are not defining the term body corporate. Body corporate includes company incorporated outside India. So here also we are providing list of items covered by the term. Is it clear? Next one, shall. It indicates mandatory. May indicates directory, optional. But sometimes these words, shall you have to interpret as may you have to interpret as a shall. For example, company may be formed for lawful purpose. Here the word may you have to understand it as shall. Company shall be formed for lawful purpose. Similarly, may, sometimes may can be interchanged as a shall. May as shall over. Shall as may also possible. For example, if you look at C&AG rights, audit and auditor, C&AG rights. C&AG shall exercise a right of supplementary audit within 60 days. So that means within 60 days, he is having a right to exercise, he is having a right to call for supplementary audit. Getting my point? So that doesn't mean compulsorily he should call for supplementary audit. No duty on him. But if he wants to call for supplementary audit, within 60 days only it is possible. So if you read word shall with right, shall, you have to consider it as may. In some cases, shall and may can be interpreted interchangeably depending on the legislative intent. Definitions. Act. Here act means negative act. Act was defined in negative manner. Simply act refers to offense. Offense. It refers to offense or a civil wrong. Shall include a series of acts and words which refers to acts done extend to illegal omissions. For example, A caused Jed's death by beating him, neglecting to provide food. This includes both act and omission. Beating him is an act. Neglecting to provide food means omission, which is legal or illegal? Illegal omission. So illegal omissions and wrongful acts will come under the definition of act. See, all omissions need not be illegal, but if that omission is illegal, you are bound to do that act, but you are not doing that act. Now we call it as illegal omission. Getting my point, students? So all illegal omissions and all acts which are negative in nature, like offenses, civil wrongs, beating a person, kidnapping a person, threatening a person, all this comes under the definition of act. Next one, affidavit. Same definition for declaration, affirmation. Same declaration, same definition for oath to swear, declaration, affirmation. See, affidavit includes affirmation and declaration. See, here we are not defining the word affidavit. Here we are providing the items covered by the word affidavit. Includes, inclusive definition. Affidavit includes affirmation, declaration by those allowed to affirm, declare instead of swearing. Instead of swearing, right from morning onwards, you will make unnecessary promises. I swear, mother promise, I didn't do it. All these are not affidavits. But if you are allowed to do by the court or by the law, then the promise you are making, the confirmation, the affirmation, the declaration you are making, we call it as affidavit. So in court, suppose witness, before cross-examination of witness, we are taking a oath from that person. It is an affidavit. A person contesting for elections, he submit a document which is notarized by the notary public, which is which is attested by advocate. So that is an affidavit. Okay. So first of all, you must be allowed to confirm or declare, and accordingly you are making a declaration or affirmation. Then it is treated as affidavit. Central Act, as I told you, Central Act, Act of Parliament, Act of Dominion Legislature, Act by Governor General before independence. That's it. Next one, commencement, section 5 I'll discuss with you, just wait. Commencement, section 5 I'll discuss with you. Document, important definition. So what is meant by document? Document, anything satisfying these 4 conditions. How many conditions? 4 conditions. We call it as document. So first of all, document shall include matter, any matter, no restriction on matter, any matter. It might be in writing or expressed or described upon any substance. Need not be a paper, maybe on iron metallic strip, or maybe on wood, or maybe on roads, zebra lines, for example, I'm telling you, zebra lines. Okay, any substance is not a matter, matter is also not a matter, any substance, but it should be in writing, expressed or described by means of letters, figures, marks, or by more than one of those means which is intended to be used or which may be used for the purpose of recording this matter. Suppose, on the screen you can see this is a document. In your hands one book is there, that is a document, you are reading it. It is having a letters, figures, it is having some matter. Why you are reading it? For examination purpose you are reading it. That means you are using it right now, or you are having an intention to use it in future, which may be used or which is to be used, intended to be used right now, or which may be used in future. So simply, what happens, all these bar diagrams, pie charts, okay, statistical reports, all this comes under document, because there you can see figures, you can also see the marks. Getting my point? Your result card is also a document. It is a proof that you cleared CA inter examination, CA foundation examination, CA final examination. Okay, so books, files, hard copy, soft copy, everything, computer files also becomes document. No, document does not include currency notes. So currency note is also having, letters, figures, marks, so printing will take place. We use it, money, we use it. Getting it? So is it a document? Actually, it is a document by applying these 4 conditions, but they clearly mentioned that document excludes currency notes. Therefore, currency note is not treated as document according to General Clauses Act 1897. Enactment, it simply means, rules, regulations, provisions, sections, subsections, everything. Act is also one enactment. Provision in act is also enactment. Section in act is an enactment. Rules made under act are also treated as enactment. Through enactment only, laws comes into the force. Financial year, as I told you, 1st day of April to 31st March. Year means 1st January to 31st December. Good faith. If time is not good, this point can be tested in the examination. First of all, as per General Clauses Act, good faith means doing things honestly. Whether the person doing act is negligent or not a matter. Negligency, carelessness is not a matter. If he is doing the things honestly, yes, he is said to be in good faith. But the problem is, as per Indian Contract Act, we are not applying this definition. Here, the person should be more cautious. The person should be not negligent. If he is negligent, that's it. If he is negligent, that's it. Good faith is not applicable to him. Next one, government includes both central government, state governments. Government securities means securities issued by CG or SG. So wherever you see the word government, government refers to central government as well as state government. Government securities means securities issued by CG, SG. Next, immovable property, important definition. Important definition. 4 things you have to remember. Land is an immovable property. First of all, this is an inclusive definition. This is not exhaustive definition. This is inclusive definition. Immovable property includes land. Benefits arising from land, crops, fruits, vegetables, everything. Until you separate them from the land, all these are treated as immovable property only. So once you separate crops, once you cut trees, once you separate fruits and vegetables, they become movable properties. But until separation, they are treated as immovable properties. Things attached to the earth, for example, buildings. Permanently fastened to something attached to the earth, buildings, and AC. Next one, furniture and fittings, if fixed to the building, like windows, doors. Once you fix it, that's it. Only with the demolition you can separate them. Until demolition, they will be treated as immovable property only. Actually, bricks, cement, sand, iron, all these are movable properties. But once you start construction, once you complete construction, now bricks in that building, okay, iron used in that building construction, sand, cement, everything becomes a movable property. That's it. Next one, trees are immovable property as they are rooted in the earth. Okay, right of way is immovable property. Right of way means, for example, this is a land. This is a land. This portion belongs to A, and this is also one more land. This is also one more land. Here also land is there. Okay, now, so this land belongs to A, this land belongs to B. For entering into B's premises, there is no way. Actually, there is no way. All sides, buildings are there. So that's why, B requested A, you just give me some space to enter into my premises. A allowed, okay. So this is a path to enter into your premises. And for this path, I will charge you some rent. So this path, I'll charge you rent. So this path, will it come under immovable property definition or movable property definition? The answer is immovable property. Right of way, access to a place is immovable property. But right to drain water is not immovable property. Right to drain water. For example, down the A's building, some water pipelines are there. Some drainage pipelines are there. And these drainage pipelines, water pipelines are connected to other buildings, other land and buildings, other buildings. Now A cannot charge them. Come on, your water pipeline is going under my building. Come on, pay me rent. Can A charge like that? No. That facilities was not given. So right to drain water is not an immovable property. Remember this point. So right of way is immovable property, but right to drain water is not immovable property. Standing crops, fixed machinery are considered as immovable property because they are connected to the land. Benefits, simply land, benefits arising from the land, things attached to the land, permanently fastened to the land, that's it, they becomes immovable property. Next one, imprisonment is of 2 types, rigorous imprisonment, simple imprisonment. Rigorous imprisonment means here prisoner has to work. In the prison he need to work, some labor is involved, hard labor is involved. Simple imprisonment means no need of labor, just sit calmly. So after expiry of your tenure, whatever tenure allotted by the court, you will be released. That's it. No labor work is involved. Simple imprisonment. Okay, now next one, Indian law. Indian law means Indian acts, ordinances, regulations, rules, orders. But important is Indian laws excludes UK acts, UK orders. Britishers came to India, ruling India, right? So Britishers brought UK acts to India. So these UK acts will not be treated as Indian laws. These will not be treated as Indian laws. Suppose Indian Penal Code is a part of Indian law, which Britishers Act do not qualify. While Britishers Act do not qualify, only IPC is applicable to India. That's it. Right now, a new code got implemented. Okay. Movable property, any property other than immovable property, it's a movable property only. Offense, you remember act. Offense is an act. I told you the word act was defined in a negative manner. A civil wrong offense comes under act. So theft is an act. Failure to pay taxes is a illegal omission. Both are treated as offenses and also treated as act. Next one, year refers to British calendar, equivalent to calendar year. That means January 1st to 31st December. In India, each and every, we are having a local years. For example, for AP and Telangana, we had a Telugu calendar year. Tamil Nadu also, Tamil New Year is there, right? So these are different periods. Of course, it might be 12 months only, but they start from different dates. So if you apply those definitions and if you come to a conclusion, within 6 months from the closure of financial year, I need to conduct AGM. So 6 months means according to which calendar, a British calendar or, religion or region calendar, British calendar only. So month refers to British month, year refers to British calendar. Next one, last point of definitions part, last point, application of foregoing definitions. Here the point is, General Clauses Act, our present General Clauses Act is not first act. 1868 one act is there, 1887 second act is there, and 1897 third act is there. Some definitions were defined here. For example, some X number of definitions were defined, and Y number of definitions are defined under second General Clauses Act, and Z number of definitions are defined under General Clauses Act 1897. Now the point is, even though General Clauses Act 1868, 1887 got repealed, but this X number of definitions, Y number of definitions will be in force not with effect from 11th March 1897 but from respective dates. For example, these definitions, affidavit, immovable property, imprisonment, month, movable property, oath to person section, these definitions will have validity from 3rd January 1868. And definitions, commencement, financial year, offense or registered schedule, subsection writing, these will be in force with effect from 14 January 1887. And these Z number of definitions, they will be in force with effect from 11th March 1897. So that means ongoing definitions, there is no effect. Foregoing definitions, there is no effect. Those definitions you need to apply from their respective commencement dates onwards. We are not giving retrospective effect. Since these definitions were defined under old General Clauses Act, these definitions will have same meaning from that date onwards. Applicability. Okay. So with this, part 1 definitions completed, Part 1 definitions completed. Now part 2, general rules of construction. So starting with section 5, coming into operation of enactment. As I told you, from part 1 definitions, you can expect one question. Part 2, general rules of construction, you can expect another question. Okay. So section 5 is coming into operation of the enactment. When a provision or when an act comes into the force is all about section 5. If any date is specified in the official gazette, then that enactment comes into force from that specified date. If no date is specified in the official gazette, then that enactment comes into force on the day it receives president consent or governor general consent. With respect to pre-constitutional laws, we use word governor general. Post-constitutional laws, president. Okay, na? Getting my point? See, coming into operation means what? Coming into force. From that date onwards, we need to comply those rules. For example, from 1st June 2025 onwards, a person driving without helmet will be punished with a 10,000 rupees fine. What is the commencement date of that rule? 1st June 2025. So coming into operation, coming into force means simply from which date onwards it is coming into force. If date is specified, then the specified date. If no date is specified, then it comes into the force on the day it receives president consent or governor general consent. And also time is important. Time is generally day begins at 12 o'clock night. Midnight 12 o'clock day starts. So from that time onwards, act comes into the force. Come on, tell me. If no date is specified, then from which date onwards act comes into the force? Enactment comes into the force. From the date it receives president consent or governor general consent. If date is specified, then specified date. Presumption against retrospectivity. So generally, if nothing is mentioned, all laws are having prospective effect. That means from specific date onwards, from now onwards to future. Prospective means from this point onwards. Retrospective means backward point of view. Standing on 1st June 2025, for example, standing on 1st June 2025, if I'm making laws telling that these laws will apply from 1st January 2025, this is said to be retrospective effect. Prospective means from the date specified onwards. Retrospective means back date onwards. Retrospective effect is generally invalid, but it is valid only if it was mentioned specifically in the act. So in the act, they need to specifically mention from which date onwards this act is applicable and what is the logic, what is the reason. Getting my point, students? Everyone, in income tax, you can see first proposal will be done in parliament. Later the act will be approved. But the point is, from the proposal date onwards, they will apply the provisions. Getting my point? Tax laws are generally prospective unless specifically mentioned as retrospective. Section 6, effect of repeal. Many students, majority of the students are reading section 6, they will ignore general clauses. Trust me, this is for sure. After reading section 6, many will ignore general clauses act chapter. That much difficulty is there in this section, they think, but it is not difficult. Let me simplify it. Repeal means complete deletion of this statute. It's not partial deletion, it's not partial omission. It's not deletion, complete, completely that law we are abolishing. As if the law never came into picture. We give treatment that act is no more, not in existence at all. But repeal shall not have following impacts. Repeal shall not have following effects. This is very important. 5 points, can be tested for 4 marks. Very, very important. Very, very important. Can be tested for 4 marks. Repeal shall not revive anything not enforced prevailed during the period at which repeal is effected. For example, our Companies Act 2013 is there, correct? Before that we had Companies Act 1956. Is it clear? Suppose government want to bring new Companies Act 2025. That's why the repeal Companies Act 2013. Example. On repeal of Companies Act 2013, don't come to the conclusion that Companies Act 1956 will prevail. No. Previous provisions which are not enforced will not get revived. See, Companies Act 2013 came by repealing Companies Act 1956, correct? If I repeal Companies Act 2013, don't take assumption that Companies Act 1956 will prevail. No. It shall not revive previous laws. It shall not affect previous operation of enactments to repealed or anything duly done suffered thereunder. For example, under Companies Act 1956 also, companies required to file annual returns. For example, for 2011-12, companies didn't file the annual return. Companies didn't file the annual return under 11-12. Meanwhile, Companies Act 1956 got repealed. That doesn't mean company is exempted from filing annual returns for 11-12. Company is still able to file annual return for financial year 11-12. It shall not affect previous operation of provisions. It shall not affect rights, privileges, obligations, liabilities acquired, accrued, incurred under the enactment. Suppose under Old Act I accept deposits from you for 3 years. Meanwhile, Old Act got repealed, New Act came into the picture. That doesn't mean my liability towards you zero. Your right on me zero. No. My liability will be continued. Your right will be continued. Even though Old Act got repealed, I am liable to you the deposit amount. You are having right on me regarding the deposit amount. Repeal shall not affect any penalty, forfeiture, punishment incurred in respect of any offence committed against any enactment so repealed. Suppose you committed crime under Companies Act 1956, you were sent to jail for 10 years. After 4 years of jail period, Old Companies Act got repealed. So now can I come outside for balance 6 years? Can I come outside because Old Act got repealed? No, sir. No. Punishments, forfeiture, penalties will still go on. Repeal shall not affect any inquiry, litigation, remedy with regard to such claim, privilege, debt, responsibility or any inquiry litigations. So ongoing legal proceedings will not be suspended. Even though Old Act got repealed, ongoing legal proceedings will not be suspended. They can be resumed. Suppose such a computers, Sahara Group of Industries, the noticed, department noticed some small loopholes, some scams in these companies. Meanwhile, old Companies that got repealed, new Companies that came. Doesn't mean all ongoing legal proceedings should be stopped immediately. No, they will be continued. 5 points. It will not revive previous laws. It will not affect previous operations. It will not affect rights or obligations. It will not affect any penalty, punishments. It will not affect any inquiry, litigations, remedies. That's it. Next one. Repeal of act making textual amendment. If any central act or regulation repeals any act that made amendments to another law, those amendments still remain valid. 6A, section 6A. Observe carefully. Central act or regulation repeals any enactment that made amendments to another law. Those amendments still remain valid. For example, Tax Amendment Act is repealed. The tax rates amended by it still apply. For example, Income Tax Act came in the year 1961. It came into force 1962. Okay, fine. So Income Tax Act 1961. In the year 2024, we modified some rates through Finance Act. For example, Finance Act 2024. Later, we repeated this act. We brought new act. If new act is silent with respect to tax rates, then you can still apply repealed act tax rates. Repealed act tax rates unless different intention appears. Suppose new act which came in the place of repealed act, it is providing new rates, it is giving new exemptions, new deductions, new set of carry forward provisions, then follow them. But if new act in the place of repealed act is silent, then repealed act provisions will apply. So Finance Act 2024, which made amendments to Income Tax Act 1961, will still survive even this act got repealed unless different intention appears. Revival of repealed enactments. Suppose you deleted, you permanently abolished one law, but once again you want to bring that law into the picture. You want to revive it. In that case, you need to disclose the reasons. What is the purpose? Why you are bringing the repealed acts into the picture? Why you are reviving the repealed enactment? You have to disclose it expressly. Next one, construction of reference to the repealed enactments. Construction, understanding, references, sections. For example, Income Tax Act is giving reference to Companies Act 1956 with respect to calculation of book profits. When Companies Act 1956 got abolished or repealed, when Companies Act 1956 got repealed, that doesn't mean Income Tax Act 1961 this provision getting repealed. This is one more point you can see here also. With respect to second point also, you can apply same logic. Listen carefully. Income Tax Act is giving reference to Companies Act for calculation of book profits. Suppose if Companies Act 1956 got repealed, that doesn't mean 115 JB of Income Tax Act also gets repealed. No, 115 JB is still continued, but you have to take reference of new act, which is Companies Act 2013. Getting my point? So if you are making any amendment, if an enactment is getting repealed, so wherever references were used, those laws where references are there, those laws are still in revival. Those laws are still in force only. They won't come to an end. They are still in force only. And repeal enactments references will be updated to the latest acts. Unless otherwise or unless different intention appears, repeal enactments references shall be automatically updated to latest enactments, latest acts. Next one, simple sections. Section 9, commencement and termination of time. When you are calculating the time period, first date shall always be excluded, last date shall always be included. For example, company declares dividend 30th September 2025. It must be paid within 30 days. So now 30 days start date is 1st October, not 30th September. 1st October onwards calculation will start till 30th October. So 30th October is the last date for payment of dividends. Computation of time. If you remember section 48, descending shareholders, 48 of Companies Act, section 48 of Companies Act. Descending shareholders have to file a petition with NCLT within 21 days of variation. Suppose if the 21st day is holiday, court holiday or tribunal holiday, then don't worry. You can file a petition on the next working day. If court or office is closed on the day, last day of the prescribed period, the act or proceeding shall be considered as done or taken into time if it is done on the next day afterwards on which court or office is open. That means next working day. Measurement of distances. Capital gains. Your identification of agriculture lands, rural agriculture land, urban agriculture land. You remember certain distance was given, 2 kilometers, based on population, 2 kilometers, 8 kilometers. Some distances were given. Now, how to calculate this distance? From municipality, your land is located here. How to calculate distance between these two places? Can I calculate distance like this? Like this? Yes. No. You have to calculate distance like this. Horizontal, straight line on a horizontal plane. So this is the distance between these two places. That's it. It's not a road map. It's not a road route. It's not a road distance. It's a straight line on a horizontal plane distance. Next one, pro rata in enactments. Very simple example. Pro rata dividends or GST taxes you take. For example, for 100 grams of gold, you need to pay 30,000 as GST. If it is 150 grams, then you have to pay 45k. If it is 50 grams, you need to pay 15k. Proportionately, I am calculating proportionately. So duty to be taken pro rata in enactments. Example, you can see dividends. For every one share, dividend is 2 rupees. Example. Now, if person is holding 10 shares, he get 20 rupees dividend. Person is holding 1 million shares, will get 2 million rupees as dividend. That's it. Gender and number. All central acts, masculine gender includes female. Singular words include plural unless different intention appears. Suppose if you take HUF, who is the karta? Male person. Who is the karta? Male person, senior male person. Their male person means male person only. Male doesn't include a female. And sometimes you can see, in companies, women director concept is there. Women means women only. So the different intention appeared. So there, masculine gender means masculine gender, female gender means female gender. That's it. Next one, singular words include plural words. Suppose, officer in default will get punishment. Suppose there are 2 officers who committed default. Now, officer in default, this officer, singular word includes plural. That means how many people committed mistake. All those people will get punishment. Getting my point, everyone? But sometimes, singular word should be used as singular word only. Singular word interpretation you have to take as singular word only. Example, sir. Previous year income, I need to pay tax in the current year. Previous year income, I need to pay tax in the current assessment year. The previous year means previous year only. It's not previous years. It's not 5 previous years. It's not 10 previous years. Okay. Previous year. Singular means singular only. Getting my point? The next one, powers and functionaries, section 14 to section 19. If a power is conferred by any central act, it may be exercised repeatedly as needed unless stated otherwise. Suppose you take small company definition or small LLP definition. Power is given to the central government to increase the limits. Contribution, share capital, turnover. So central government can use this power from time to time. There is no restriction on usage of this power. Only one time in a year, one time in a month. There is no such restriction. If you want, you can use it. The powers can be exercised repeatedly as and when needed. Power to appoint includes power to appoint ex officio. Suppose IEPF authority is there. I can name IEPF authority chairperson using his name, Mr. Ravi. You are chairman of IEPF authority. Or I may also use like this. Secretary of MCA is a chairman of the IEPF authority. So here power to appoint a person. I can also use ex officio. That means by virtue of his office. By virtue of his office, he can be appointed as a person in this committee. Getting my point? Direct tax committee. I say president is a default member of direct tax committee. So how naming is done, how appointment is done? Through his name, through ex officio. Through ex officio. So power to appoint also includes power to appoint ex officio. Next one, power to appoint includes power to suspend, power to dismiss. 2 times question came on this. In any partnership deed or MOA or LLP agreement, suppose there is a point that designated partner can appoint employees. With respect to suspension, dismiss, there is no point in the LLP agreement. There is no point in AOA. There is no point in partnership deed. But that doesn't mean they had no power to suspend, they had no power to dismiss. So power to appoint includes power to suspend, power to dismiss. If I am having authority to appoint you, I can remove you. That's it. Substitution of functionaries. For the purpose of indicating application of a law to every person, number of persons for the time being executing the functions of an office, it should be sufficient to mention official title of the officer at present executing the functions or that of the officer by whom functions are commonly executed. For example, you take ROC. For getting certificate of incorporation, we need to file in documents with ROC. Suppose Mr. Ramu is a registrar. So here we can use the word Ramu. File documents with Mr. Ramu or file documents with ROC. So we may use official title of the officer. Sometimes managing director of the company. So we can give reference like this. Reliance Industries Limited managing director or Mr. Mukesh Dhirubhai Ambani. Both are same. So we use functionaries. We can substitute functionaries with their title names. We can call them with names, or we can also mention official title of the officer. It shall be sufficient to mention official title of the officer. Even if observe, you can see in Companies Act also, for non-maintenance of books of accounts, MD, CFO, finance, full-time director finance, CFO will get punishment. There, we are substituting functionaries with official titles. So now the person who is in charge of the designation, who is having the designation, will get punishment. Successors. For purpose of indicating relation of a law to the successor of any functionaries or corporations having perpetual succession, it shall be sufficient to express its relation to the functionaries or corporations. Suppose MD is having, for example, 10 powers. Right now, Mr. A is MD. A resigned or A retired or A died or A became insolvent, B became managing director. Automatically, all these 10 powers, B can exercise. That's it. Successors will also get same powers. That's it. Official chiefs and subordinates. A law related to the chief officer shall apply to deputy subordinates when the chief officer is absent. Suppose if ROC is there, ROC will issue certificate of incorporation. ROC is not there, then deputy ROC, additional ROC or assistant ROC, they can execute the functions of ROC in the absence of ROC. Clear? Next one. Construction of orders issued under enactments. Any notifications, circulars, orders, schemes issued under any act, the expressions used in them shall have respect to meaning of the act unless otherwise specified. Suppose the word company is defined in Companies Act 2013, and the same word company is not defined in Companies Amendment Act 2015, not used in Companies Amendment Act 2017, not used in Companies Amendment Act 2020. Imagine 2019 or 2020. Sorry, 2019, for example. So, on all these amendment acts, wherever the word company is used, if not explained, if not defined the word company, then you adopt same meaning that is there in the original act. Time to time, central government is issuing rules. For example, small company, they are increasing the limits, issued a rule. So, they didn't define the word small company. Now come back to original act. As per original act, small company means it's a company other than public company. Same meaning will apply. Respect to meaning in the act will apply unless otherwise specified. Power to issue, amend, vary, resign notifications. Power to issue rules also includes modifying, varying, resigning them in the same manner. Making rules, bylaws before enactment comes into the force. Listen carefully. Rules framed before an act is enforced, remain valid and preparatory to its implementation. Only when provision got enacted, when provision comes into the force, then only the rules, bylaws with respect to provisions comes into the force. If a central act regulation is passed but does not come into force immediately, any power granted under it, make rules, issue orders, establish courts and appoint officials can be exercised right after the act is passed. However, these rules or orders will only take effect when act or regulation officially begins. Suppose NFRA, for example, you take NFRA. Section 132 was there in Companies Act 2013, but it was not notified. It was notified later, in the year 2018. Up to that point, NFRA cannot exercise its powers. Once it gets notified in the official gazette, then only NFRA can exercise its functions, NFRA can exercise its powers, NFRA should fulfill its duties. Until then, the provisions are there, but they will not have any validity. They will not, no need to apply those provisions. Provisions for making rules, bylaws after previous publication. Suppose, Companies Act 2013 was enacted. Rules were framed in the year 2014. Many chapters rules were framed in the year 2014. Now, what is the procedure for making these rules after enactment of Companies Act? That is a point. First prepare a draft, publish the draft. Affected people will make some recommendations. Affected people. And you have to specify them, starting date of this draft, commencement date of this draft. The rule making authority, along with any required approving authority, must review the objections, suggestions, recommendations received before the specified date. And authority may consider them or authority may ignore them. So once those rules got published in official gazette, those rules, bylaws is considered legally valid and properly made. The process of making, even though some legal lapses are there, but still they're said to be valid only. They're said to be valid. They're conclusive in nature. You need to follow them. That's it. And there is no compulsion on the authority to consider objections raised by the people, to consider suggestions raised by the people. Just recommendatory in nature, not mandatory. Next one, continuation of orders, etc. issued under repealed acts, repealed enactments, repealed laws. Now, for example, Companies Act 1956 got repealed. In that place, Companies Act 2013 came, but this Companies Act 2013 didn't came on a single day. First, some 98 sections were notified on 13th September. 180 plus sections were notified on 1st April. Winding up related provisions were notified later. So the rules related to winding up, until Companies Act 2013 notifies them, until under Companies Act 2013 provisions related to winding up get notified, until that point, rules made under Companies Act 1956 are applicable. Sir, Companies Act 1956 already repealed, sir. Correct. I agree with you. But until new rules comes to the picture, the old rules, the amendments which were made under old acts will apply. If Central Act or regulation is repealed and reenacted, that means Companies Act 1956 repealed, Companies Act 2013 reenacted. Unless stated otherwise, all appointments, notification, rules, orders made under old law will continue to be valid under the new law. Appointment of MD, notifications with respect to annual returns, winding up procedures, rules related to winding up made under old law will continue even under new law. If law previously extended to a specific area is later withdrawn and then re-extended, it will be treated as repealed and reenacted for that area. Companies Act 1956 is applicable to whole of India except Jammu and Kashmir. New Act also applicable to whole of India and Jammu and Kashmir. That is, New Act is applicable to whole of India except Jammu and Kashmir. Right now, all central acts are applicable to all the areas in India. This section confirms that if law is repealed but reenacted with same or similar provisions, repeal is neutralized and provisions remain in force without interruption. So provisions with respect to winding up, they are said to be in force until new rules get implemented. However, if the reenactment introduces significant changes, then the modified parts replace override old provisions. So our Companies Act, when rules related to winding up get notified, then old rules will not apply. Old rules will not follow. No need to follow old rules. Old rules are not applied. Mines Act 1952 repealed Mines Act 1923, but rules under old act continued until superseded under new act. Miscellaneous, last point, recovery of fines. How fines will be recovered. For that, IPC is giving reference to CRPC. Under CRPC, how fines will be collected. Similarly, fines will be collected under respect to central acts. Next one. Offences punishable under two enactments. Important point. Offences punishable under two enactments. Same offense, no change in offense. That offense was described in both the acts. For example, fraud was notified. Fraud was explained in Negotiable Instruments Act as well as Indian Penal Code. Now, prosecution, legal proceedings may happen under two enactments, but punishment will be only under one act. Suppose IPC told 8 years imprisonment, Negotiable Instruments Act told 2 years imprisonment, 8 plus 2, 10 years. No. Only one punishment, one imprisonment will be applied. Only one imprisonment will be applied. Getting my point, students? Everyone, but important point is the offense should be similar. It should be explained in a similar way under both enactments. An accused acquitted under IPC can still be convicted under Prevention of Corruption Act, even though acquitted means released from all charges. Under IPC, he may be innocent, but under other act, if his conviction is proved, if he was proved that guilty, he will get punishment. First of all, it applies to if two offences have same ingredients. If they are distinct, the prosecution under both laws is valid and punishment under both laws is valid. Suppose, I didn't pay tax. I created some black money. Through Hawala, I transferred that money to other countries. Now, I did two offenses. One is non-payment of taxes, other one is Hawala. So, two different offenses, Income Tax Act applicable, Money Laundering Act applicable. Accordingly, I get punishment separately. Next one, meaning of service by post, very important, unless otherwise specified. If that post is properly addressed to prepaid stamp duty posted by registered post, assume that notice reached recipient. Whether recipient ignored it or not, whether recipient is not taking it or not, we assume that recipient received that notice. That's it. But no, expressly when it is mentioned registered post acknowledgement due, then post shall be sent only through registered post acknowledgement due. If everything is silent, if nothing is specified, then post is validly, post is deemed to be served only when it is properly addressed, prepaid, and posting by registered post. Citation of enactments. References. An act may be cited by its title, short title, number, year. Companies Act 2013 or Act number 18 of 2013, both will have same usage only. Companies Act 2013, or I can call it as Act number 18 of 2013. Both had same saving for previous enactments, rules, bylaws. New provisions do not affect the interpretation of the laws, rules, and bylaws made before Act commencement. Rules under Mines Act 1923 continued under Mines Act 1952 until it repealed. Already explained this point. Ordinances. Generally, ordinances acts both have same applicability, but the difference is Act will have unlimited time validity period, whereas ordinance is having a limited validity period. Ordinance tenure comes to an end by the expiry of 6 weeks from the commencement of parliament sessions. Once parliament sessions conducted, ordinance will lose its validity after 6 weeks. Generally, the journey of Act, bill approved by Lok Sabha, Rajya Sabha, President, it becomes Act. But ordinance is a bill directly approved by President. Even without approval of Parliament, sometimes President may give approval depending on emergency situations. So ordinances will have limited validity span. The span is 6 weeks from the commencement of Parliament sessions. Within 6 weeks of Parliament sessions, Parliament should approve that ordinance, or else that ordinance lose validity. But Central Acts include ordinances made under various laws. Ordinances under Article 120 of Constitution are treated like acts with a limited validity period. So with this, general clauses are completed.